Thursday, October 24th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Madison Mills, and let's get you the three things that you need to know today.
First up, U.S. stock futures rising after 3 days of losses as Tesla delivers blowout results with its biggest quarterly profit in more than a year. The EV maker forecasting 30% growth in vehicle sales for this upcoming year. Investors now looking ahead to the rest of the Magnificent Seven results next week, NVIDIA withstanding. We've got all eyes on AI.
Plus, earnings season continuing this morning with one of the busiest days of the third quarter. We've got results from Southwest, American Airlines, Honeywell, Capital One, UPS, and more. Southwest reaching a deal with activist investor Elliott, announcing 6 new board members. Meanwhile, UPS, those shares are surging after the company beat revenue forecast for the first time in 2 years.
And Boeing shares falling this morning after factory workers rejected a contract that would have raised wages 35% over 4 years, worsening the crisis at the plane maker. Some 64% of the union members who cast ballots voted against the agreement. Bank of America analysts saying the news adds further uncertainty, costs, and recovery delays as the strike approaches day 40. Let's start with Tesla's third quarter. The company adding $80 billion to its market cap on the back of those strong results. For context, that's about the size of the entirety of Chipotle. Now, one key focus in the earnings was robo-taxi optimism, with Musk saying on the earnings call that we do expect to roll out ride-hailing in California and Texas next year, adding that he believes driverless Teslas will be doing paid rides sometime in 2025. Shares of ride-hailing apps Uber and Lyft under a bit of pressure this morning on the heels of that. But I do want to point out a little bit of a reaction that we got from RBC Capital Markets, saying that they believe Uber and eventually Lyft's tech-agnostic approach is actually going to be a stronger approach because they're not going to be relying on kind of one single company moving forward here. However, they do say if Tesla's ride-hailing plans do gain traction in either Texas or California, that could be a potential pressure point for Uber and Lyft here.
Yeah, I thought the RBC note in reaction to this really just sums up maybe what the next several months could look like here for all of these companies, because it could be a potential overhang, yet it's still so much of a show me story. And I feel like that has really been showcased in the reaction that we initially saw to the robo-taxi event, some of that disappointment. And then when you hear some of the optimism, some more realistic timelines or timelines in general, that is enough here to offset some of those concerns. And we're seeing that reflected in Tesla shares up this morning, up nearly 15%. And then you couple that with the growth trajectory and some of the growth estimates and what Musk has laid out. So much of it, though, really relying on, it seems like at this point, a cheaper models. And I think the fact that we still don't have many details surrounding that is something that some analysts are calling out this morning, just in terms of some of that uncertainty that still lies ahead. But again, when you take a look at these results and more importantly, the commentary that we got on the call, some of the more details in terms of the timelines that we are going to get for the announcements ahead, I think that is enough to encourage the street now. And as a result, we're seeing some pressure on Uber and Lyft.
Absolutely. And it's interesting, too, to point out the fact that we get a lot of stories on the Tesla earnings call. So hoping for that clarity moving forward, that will certainly solidify the impact something like this could have on those ride-hailing stores.
Well, investors also cheering Elon Musk's optimistic forecast of 20 to 30% growth for Tesla next year. To discuss Tesla's latest quarter, we're joined by longtime Tesla bull Dan Ives, senior equity analyst and managing director at Wedbush Securities. Dan, I know you've got a lot to like within this report. I'm curious, just what was the number one thing that stood out to you that got you the most excited following this print?
Yeah, I think margins. I mean, that's been a huge part of the overhang on this story. They beat by 200 bips, price cuts in the rearview mirror. And when you combine that with that growth forecast, I mean, I did whisper numbers were called 10, 11%. They gave 20 to 30%. It's an Aaron Judge-like quarter.
It's interesting because they teased out more affordable models for the first half of 2025, but then Elon said a $25,000 vehicle would be silly. Is he really prioritizing cheaper EVs? Where do you find the clarity on that?
Yeah, I think you'll have a sub 30K vehicle by first half of next year. And I think that all dovetails into their overall growth forecast, 20 to 30% coming out of the gates for 2025. And now we look at their cost of goods, their ability to produce cars is down ultimately 30-40% and could be down another 20-30% when you look at the next year. It has been a painful year, no doubt, in terms of EVs and softer demand, what we've seen on margins. The renaissance of growth now is, I think, heading into 2025. And then you have AI, autonomous, and I think a lot of the other growth drivers that, to me, it's key to what I see as a $1 trillion plus market cap.
So, Dan, I guess 30% growth or up to 30% growth next year, it sounds like you think that's realistic.
Oh, yeah. No, look, the bears that have been bearish since, 100 million market cap, those bears will come out of hibernation mode today. But the reality is that they're going to produce over 2 million vehicles next year. And when you think about the overall growth story, more penetration on the FSD. I gave, I think, ultimately more details last night in terms of autonomous, FSD, cybercab. A lot of those details, maybe some left. Robotaxi today, disappointed. I was not. And look, now it's just execution. But to poke holes in this story, I believe the most undervalued AI play in the market.
But when is that autonomous AI growth actually going to be here, Dan? I hear you. I hear what you're saying. You call it the most underpriced AI story in the market. But when is that going to be on the balance sheet as opposed to a story I'm hearing about on the call?
I think like me and you, we could be in a cyber cab in the next 2 to 3 years. So we're not talking about something that's 5-10 years down the road. This is something that will, over the coming years, become a reality. And I don't necessarily view this as a negative for Uber. Lyft obviously has their own issues. But when you look at Tesla, this is going to be the next stage of growth. Autonomous, FSD, AI. But it comes down to you need the deliveries, you need the margins. They're checking every box. I actually thought that was probably the best conference call I've heard from Musk and Tesla in a number of years.
Dan, one of the things that he talked a lot about on that conference call that you're mentioning there is he spent time talking about what he might do in a second Trump term if Trump were to be elected come November. I'm curious just how much of some of this recent momentum or the next several years in terms of their growth prospects hinges upon a Trump victory in November.
Yeah, I wouldn't say that it hinges on the Trump victory. I think Trump or Harris, I don't think the growth story vastly changes. I do believe if Trump gets elected second term, it's bearish for EVs because overall the tax credit would essentially go away. But I do believe that it's bullish for Tesla because that ultimately would give them more scale and scope versus other players and potentially could fast track FSD and some of the other technologies that ultimately we see under a Trump administration. I do think Tesla is part of that, I'll call it Trump trade.
All right, Dan Ives, thanks so much for joining us as always. Appreciate it.
Thank you.
We're going to broaden out to the Magnificent Seven as a whole as we're still waiting for some other members to report results next week. What could that mean for the broader market? Joining us now in studio to discuss, we've got Ayako Yoshioka, Wealth Enhancement Group's Portfolio Consulting Director. Ayako, it's great to have you in studio with us. Yeah. I'm curious, how much of a read-through do you think the Tesla results actually have to the rest of the Mag 7?
I think it's always been hard. Tesla's been sort of on its own relative to the others because they're more hyperscalers and cloud players more than anything else. But it's nice to see the margins come through. I think that's one of the things that everybody's going to be focused on for the other Mag 6. So.
It's so interesting when you take a look at the recent trading action that we've seen in Tesla. And we had Jay Woods on the program yesterday, and he was making the case that it makes much more sense to trade Tesla or invest in Tesla on a technical basis versus a fundamental basis, just given some of those trading patterns. I'm curious, is that something, do you share that view, or do you see maybe today's move a reflection maybe more so of those fundamentals?
Sure, I think it's more of a reflection of the fundamentals today, but you always have to consider some of the technicals as it relates to all stocks, right? You can see whether or not stocks are overbought or oversold, and perhaps that helps you with both the entry and exits.
Just broadly, is this AI bull market alive and well, right?
I think it is. I mean, there's going to be fits and starts, and it's not going to be, going up in a straight line. But I think the AI technology and how that is going to continue to be proliferated in terms of productivity for many companies is still in the early stages.
Who's best positioned at this point?
Beyond NVIDIA, I think it's it's going to be the software companies going forward. They are going to be the ones who are going to be able to utilize a lot of the productivity that's going to come out of the AI theme, and companies like Salesforce. I think all of that data is going to be able to get in better productive use from a lot of their clients.
What do you make of the IBM story then? Because some of that seemed like a little bit of a headwind coming from AI to their broader consulting business.
It is, but I think IBM is going to help a lot of companies out in terms of understanding how to incorporate it, how to get the most out of that AI from all of their data that they have.
Is IBM an attractive player right now to you in this space?
I think so. It's always gotten less favorable sort of coverage. I think because it's part of that old school tech. I think it falls into same place as Oracle, IBM. They kind of get left behind because of all of the shiny attention that Amazon and Microsoft and Google get. But I think those are great tech companies as well.
I want to talk specifically about some of the semiconductor names. I noticed this morning we only have 30% of the S&P semiconductor names trading above their 200-day moving average. And it makes me wonder, is the semiconductor chips rah-rah rally over, or is it just a winners versus losers moment?
Well, I think you have to look at the end markets. So, where the end markets are a little bit more AI focused, so that's why NVIDIA and Broadcom have continued to do well. But then, some of the more semiconductor companies that are focused on industrial or auto, they've had a little bit more of a struggle.
Yeah.
And so I think it just depends on where the end markets are.
And when does that start to change, right? Texas Instruments this week talked about that a little bit.
Exactly. And I think, on the auto side, you are seeing some of that excess supply kind of linger. Yeah. And then on the industrial side, I think lower rates, which we've just started to see, are going to help as we go into next year.
How much emphasis should we be placing, and going back to where we started the conversation when it comes to Mag 7 this earnings season, how much emphasis should we be placing on these results versus the rest of the market? Because we have been talking about this broadening, yet when you take a look at the outperformance and where we are expected to see the most growth, it is still tech.
Sure, and I think a lot of it has to do with just the concentration of the S&P 500 and the weight of all of these, Mag 7 companies. But I think what we're going to be looking at is that CapEx spend from all of these hyperscalers. I think that's going to determine whether or not they continue to lead or not, and whether or not they pull back on some of that CapEx
risk of that,
spend.
you think?
I don't think it's a risk sort of in the near term, but I think they're going to evaluate it at some point and see whether or not they need to continue at the pace that they've been at over the last few quarters.
When do the hyperscalers and the chips companies turn that co-opetition into a competition that's bad for potentially either stock?
I think it's still so early on in the development of all the data centers with AI that it's going to be a while. I think it's going to be a few years before it turns into true competition, because we're still in that phase even with cloud, and that's been around for so long. So.
And as we wrap up this conversation, there's been so much emphasis or maybe chatter over the last several weeks for whether or not Tesla should even be included in the Mag 7 if a name like Netflix makes more sense. I'm curious to get your thoughts on that and ultimately just how much it matters.
I don't know if it matters all that much whether you include one stock versus the other, and it's really more about just the weights within the index and how they are going to contribute to the overall returns, just because everybody's involved in some of the ETFs there.
Who would you want to put in? If Tesla got kicked out, who would you put in?
Oh, that's a good question. Probably Netflix. I think that makes the most sense.
All right, so it's great to have you. Thank you so much for joining us here on set. Really appreciate it.
Thank you.
Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street as U.S. futures get a boost on the back of Tesla's results. Plus, we'll bring you the latest on Boeing as more than half of its union votes to reject the manufacturer's offer. And a programming note, tune in to our new podcast, Yahoo Finance Sports Report. Hosted by Joe Pompliano, we will be breaking down the financial side of the game for your financial gain. Catch new episodes Thursdays on your favorite podcast and streaming platforms.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we've got Boeing. Union workers rejecting the company's latest labor contract that offer including 35% raises over the next 4 years. Now, this extends the more than 5-week strike that has halted aircraft production, costing the company about $1 billion per month. Union leaders saying they are ready to resume negotiations immediately. Boeing declining to comment on that vote. But it's interesting, Shauna, because the last time they had this vote, it only got 6% approval from voters. Now that went up to 36%. So this morning, Jeffrey saying that's potentially a good sign that we're getting closer to that 51% requirement that is needed, perhaps indicative of progress, but perhaps it's also just indicative of some workers who maybe really need their health insurance back. So we will see whether or not that leads to a decision finally being made, which would certainly be a lift for shareholders.
Yeah, certainly. And it is hard to determine what exactly are the driving factors behind that vote. I think you can look at it as the fact that there has been significant progress, comparing to the fact that over 90% of the union voters have rejected the initial offer. So again, when you take a look maybe at some of the progress that has been made. On the flip side, though, with the extent and with the number of union voters that still rejected this deal, it's very indicative of the fact that these negotiations still potentially have a long way to go. And as we talk about how big of an overhang this could potentially be on Boeing, here we are towards the end of October, and October has essentially been a washout in terms of this. We've already talked about the fact that Boeing has been forced to suspend work on a 737, on the larger 767 and 777 airline models there in the Seattle manufacturing hub now for more than a month. So the fact that it has already been weighing on their bottom line just a bit. And then, of course, when you look ahead and you put into context the possible credit rating companies here putting their credit rating on alert here for potential downgrade, and ultimately what that would mean for Boeing's business going forward, it is still a bit worrisome, the fact that more progress has not been made.
Absolutely.
All right, let's take a look at airlines. We're getting results from more of them this morning. We got American Airlines beating earnings and revenue expectations, raising its 2024 profit forecast after shifting its sales strategy to win back corporate clients. Then you've also got Southwest here this morning, actually just a fractionally moving to the upside here, reporting better than expected results. That was boosted by higher prices. Still, profit fell 65% from a year ago, hit by higher expenses. Meanwhile, Southwest and activist investor Elliott Management announcing that they've struck a deal to avoid a proxy fight, the deal allowing CEO Bob Jordan to remain in place. It also adds 6 new directors to the company's board. And it also speeds up the retirement of executive chairman Gary Kelly. A lot to unpack there. Let's first start, I guess, with American Airlines, since we led the reader with that, and talk about maybe a bit of a turnaround that we're starting to see within that airline, because full year profit, it did top analyst expectations there, a sign that the company's pivot and strategy that we have seen, especially from the last quarter here, certainly seems to be paying off. When you take a look at that rosier outlook there compared to what we saw from American's earnings projections back in July when they were cut for a second time this year. Obviously, this is very welcome news here by the company. You're looking at shares over the last 3 months, they're still firmly in the green, up just about 22%. But year to date, it's a stock that still is below the flat line, vastly underperforming the S&P 500. You're still looking at losses of about 6%.
And one kind of through line we can draw from American Airlines over to Southwest, ticker LOVE there, is this idea of revenue per available seat mile. That was a little bit disappointing to analysts for both companies here, specifically talking about Southwest. We have a response here from Tom Fitzgerald over at TD Cowen, maintaining his hold rating on Southwest here, talking about how their conversations indicated that the buy side was looking for that revenue per available seat per mile to be at the higher end of the guidance range. That came in up 3.5%, hitting 5.5% year over year here, but that was not enough for Southwest. Having said that, we did see both of these stocks kind of moving around a little bit on the heels of the news. Certainly Southwest getting a little bit of a mixed report for those quarterly earnings beating estimates, but then fourth quarter cost guidance looking like expenses for the company are going to weigh on the balance sheet moving forward. And if they can be defensive on that, that's potentially going to change things for Southwest. You can see here those shares still ticking around a bit this morning. Finally here, IBM falling short of third quarter revenue expectations, weighed down by its consulting and infrastructure units. Still, the company has seen strong AI demand. The tech giant expecting revenue trends to continue in the next quarter, driven by strong software sales. And it's interesting, we were just talking with our guest here, Ayoko, about this, and she mentioned that IBM is not your old school blue chip name anymore. It is one of those AI plays, but I think the AI impact on the consulting business in this case is potentially viewed as a headwind for the stock near term, but maybe the question is whether or not more long term it could be a more positive lift.
Yeah, and I think that some of this was forecasted and expected when you took a look at some of those preview notes coming out from analysts, the fact that the AI business was going to weigh on or take away some of that business or demand, I should say, in terms of their traditional consulting business. I don't think necessarily comes as a surprise here for IBM. When we have some of those longer term charts up on the screen, year to date, you're looking at gains of 42%. The street has been very encouraged by the strategy, by some of the steps that IBM has taken now. Most recently there, over the past 2 years, you're looking at gains of 80% under the CEO, Arvind Krishna. And when they talk about the future growth, I think very much, yes, this quarter might have been a bit mixed. You might have seen a number of reasons to take issue with these results. But as you look at the trajectory and where that CapEx is flowing from, at least from many of those larger companies, a lot of it is on AI. So as long as IBM continues to push their presence within that space and makes it relevant, more relevant within that conversation, obviously positioning themselves for that future growth.
And we know our very own Brian Sazzi sent this over to us, IBM's CFO, saying, I think in my personal opinion, it's going to be the longest adoption curve that we'll see because it'll play in many different industries and many different clients. This on the heels of Yahoo Finance tracking IBM's moves towards adding $1 billion in AI project backlogs per quarter. And I know, Shauna, you've got a big interview coming up with IBM as well.
Yes, Arvind Krishna, he will be joining us at Yahoo Finance's Invest. That kicks off on November 12th. We're really looking forward to that. It's an exclusive interview. We look forward to talking about all the things that we learned in this earnings call and more as IBM positioned itself for future growth. Coming up next, we will have more on earnings. ServiceNow CFO joining us live with a look at the company's results and its AI strategy. You're watching Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
You've got 1 minute until the opening bell on Wall Street. So let's do a quick check of the markets. We're still in the futures territory here, but you've got a sea of green, right? You've got the Nasdaq futures up 0.7%, the S&P 500 futures up 0.3%. The Dow still under pressure, probably on the heels of that McDonald's related news. I do want to take a look at the 10-year, maintaining that level above 4.2, moving around a little bit this morning on the heels of those initial jobless claims coming in better than expected. That also could be one potential reason we are seeing a lift to the broader futures after those 3 days of losses on the S&P 500. So we will continue to monitor how that changes throughout the course of the day, but those initial jobless claims numbers coming in below expectations, perhaps a key driver of the macro picture today. All right, we've got the opening bell here on Wall Street. You can see on your screen the New York Stock Exchange and the Nasdaq. But let's get over to Yahoo Finance's Jared Blickery for a broader look at what's moving markets this morning. Hey, Jared.
Hey, Maddie. Well, I think the higher dollar and higher bond yields finally started to take its toll on the equity markets. And there's a bunch of other stuff going on too, right? A lot in the earnings space. But today we are seeing the Dow down about 0.2% or about 100 points. Not a big deal there. Nasdaq just coming off the worst day in 6 weeks. Let's take a look at what's been happening this week. So I'll do a 4-day chart. You can see down about 0.6% for the week. And then the Russell 2000, still waiting for that first print there, but that was down 5 days. Now, I did mention bonds and the dollar. Fortunately, those are taking a little bit of a reprieve today, just kind of edging to the downside a little bit. That's 10-year T-note yield. Here is the U.S. dollar index, and there you see that's down about 0.25%. So no pressure from those two markets today. And we're taking a look at the sector action. Consumer discretionary, that is a Tesla story. XLY is up 2%. Tech also getting a boost. They're up about 1/3%. Utilities taking up the caboose. That's down about 45 basis points. And I did want to take a quick look over the Nasdaq 100 and take a look at Tesla having its best day since April. And I'll give you a year-to-date look there. You can see just about climbing back to the unchanged line for the year. Finally, I want to leave you with the ongoing saga in silver. We are seeing that up another 1.72%, just clawing back some of those small losses from yesterday. So not a record, but very close, guys.
All right, Jared, thanks so much for breaking that down for us. The U.S. 10-year yield hovering just above 4.2 as markets reprice the outlook for Fed rate cuts this year. Our next guest flagging the fact that the higher yield could be a potential headwind. Let's bring in Keith Lerner. He's Chief Market Strategist at Truist for more. Keith, it's great to see you here. So let's talk about the level that we're at right now. So we're right above 4.2. At this level, is it a bit challenging, or is it when we push up against 4 or 5? What does it look like?
Yeah. Well, first, great to be with you and Madison. Regarding the 10-year, so I think we need some context before we say how much trouble this is going to be, because we've been up 10 out of 11 months and we're coming off a 6-week winning streak. So I think with that and sentiment getting a little bit hot, that a rise in 10-year does provide a little bit of a challenge. But what I'm encouraged by somewhat here is that when I look beneath the surface and I look at what's called credit spreads, so are we seeing some systemic? We're seeing credit spreads near the lows. So that's telling me that this is the yields are moving higher because investors are feeling more comfortable with economic growth, and at the same time, that's peering back on how aggressive the Fed will be. So I don't know the exact magical level. I think from here to maybe 450 will be a challenge, but I think it's also because the market's at a spot that has moved a long way in a short period of time, and this is an excuse for the market to at least digest and maybe trading a little bit of a choppier fashion, in addition to the election now about 2 weeks away.
Yeah, and that election coinciding with the early month macro data we're going to be getting, what do you think is going to drive the market more heading into the start of November?
Depends on which day you ask me. I mean, on the day of the election, it'll be all about the all about the election. I mean, we will that employment report comes out a little bit before, but what I'm seeing, I've just been on the road here recently. I mean, the focus is really centered on the election. So I think the employment data will matter, but the first getting over the hump on the election, I think is really going to help investors kind of get a better idea of the landscape. Even though it will be likely a choppier period, we don't know if we're going to know the results that day, and if there will be any contested election, all of the stuff that we don't know. But I think that's going to be the biggest impact because that's all people are talking about right now.
Keith, what do investors need to prepare for in terms of what that activity is going to look like around the election?
Well, it's interesting because this year, I will say, we're not really following the historical script that closely. The first thing to be aware of is this is the strongest year for the S&P 500 in any election year, at least since the 1950s. What tends to happen, though, is you tend to have a little bit of a buildup of anxiety as you get closer. I almost feel like people have signed, even though there's been a lot of rhetoric, I think some investors have almost ignored some of this focus on things. And when it comes, I think we will actually have a deep focus. But you tend to have a little bit of a spike in volatility heading into the election. And once you get clarity, then the market tends to have a sigh of relief. And in an election year, the final 2 months of the year, you've averaged a gain of about 3%. So, again, keep that in mind in a historical context. But I think after we get through the election, markets will then refocus back on the fundamentals and, the Fed and the economy and everything else.
Well, one of the other fundamentals of our economy right now feels like NVIDIA. Torsten's log out with a chart this morning talking about how NVIDIA has a bigger market cap than 5 of the 7 G7 countries. Retirement accounts, index funds, all over indexed to this one tech name. Can we continue to be a bull market that's relying so heavily on NVIDIA?
Well, if you look overall, I mean, you still have over 70% of stocks in the S&P in long-term uptrends. So NVIDIA has been a big part of the market this year, but we also have to realize up until this recent breakout, which is only a marginal breakout, it's really moved sideways since July. And what you saw is other areas of the market, do fine, and the market moved to an all-time high, even though NVIDIA was trading sideways. But I do think it is a bellwether for semiconductors and technology. Technology is about 30% of the overall S&P. So it is important that tech participates. We still like tech. We upgraded our view of tech on the pullback in August, and I still think the theme of this bull market is still AI. If you believe the bull market is intact, which we do, I think you have to still believe that there's still further to go on the AI side. So it likely has to participate. But again, look at the financials making an all-time high as well, and up until today, industrials were doing better. Utilities, even though these rates are moving higher, another area where overweight, also doing relatively well.
All right, Keith, we got to leave it there. Really appreciate you joining us. Thanks so much.
Great to be on. Thanks.
Software maker ServiceNow beating third quarter estimates and raising its subscription revenue guidance, boosted by strong sales and bookings. The company also announcing a leadership change, naming an industry veteran from Google Cloud as President, Chief Operating Officer, and Chief Product Officer. But investors were hoping to see more on artificial intelligence. So joining us now to discuss, we've got the company's CFO, Gina Mastantuono, ServiceNow's CFO. Gina, thank you so much for being here with us this morning. I want to start on the beats that you saw and in terms of the guidance kind of coming in at the midpoint for revenue. What do you attribute that to?
So thanks so much, Madison, for having me. It was absolutely another spectacular quarter here at ServiceNow. We're seeing strong demand across the board, and the elite level execution that our team is driving has just been remarkable. And you're absolutely right. We had strong beats across the board. We beat revenue 22% constant currency growth. We beat our guidance, the high end of our guidance, by the way, by 200 basis points. We had RPO at 33% and op margin beating by 150 basis points, which really allowed us to, again, raise the top line growth outlook for the full year. And a lot of what we're attributing it to is our Gen AI success. So we've been able to raise revenue guidance from the beginning of the year over 100 million. And that's a lot to do with our Now Assist, which is our Gen AI products. It's been the fastest growing new product in company history. And really what you're seeing is our Gen AI solutions resonating. We talked about 44 customers spending more than $1 million with us, and 6 customers spending more than $5 million, 2 spending more than $10 million on our Gen AI products. And what you're really seeing is that our relevance as the AI platform for business transformation is soaring as CEOs are really looking to modernize for an AI world.
So Gina, what does that tell us? There has been some concern about maybe the fact that AI is overhyped to some extent, the fact that some corporations are going to be pulling back a little bit on their IT spending. It doesn't seem like you're seeing any signs of that.
Well, I'll tell you, Shauna, here's what customers are telling me. They're really looking to move from experimentation into implementation. And evolution is likely going to happen fast. Most are realizing if they're not pivoting to broad-based adoption in the next 2 years, they might lose out. And we're seeing the AI adoption curve faster than cloud. I talked about a few minutes ago. It is our fastest growing new product in our history. And that's because customers are really realizing that that adoption curve is probably going to be faster than anything that they've seen, and they want to get on board pretty quickly.
There was a concern among some analysts about the operating margin guidance, saying that seemed to be the one negative they could point to amongst a rather robust earnings print. As the CFO, what are you thinking about in terms of increasing that guidance, moving that to the upside moving forward? How are you thinking of navigating that?
So year over year, our operating margin guidance, where it is accreting by 200 basis points already. And so what we're always trying to balance is the investment for growth versus profitability. And so from our perspective, the opportunity we see is so large that the outperformance we're seeing, we're putting back into the business because we're already accreting our margins pretty remarkably already. And so if we have the ability to invest further to drive even more top line growth, we're going to make that choice probably most days of the week.
Gina, another thing that was talked about on the conference call and something that you've really been doubling down is just with your work with NVIDIA, extending that partnership, what exactly that looks like for ServiceNow going forward. I'm curious, how critical is that partnership with NVIDIA to your business?
Well, it's a remarkable partnership, and we've been close with NVIDIA and talking about continuing to evolve that partnership for quite a while now. The new partnership we talked about is co-developing native AI agents on the ServiceNow platform using NVIDIA NIM Agents Blueprint. And that's all about turnkey out-of-the-box AI agents for our customers. And we're beginning with security vulnerability as the first use case. And so really excited that our partnership with NVIDIA just keeps getting stronger and stronger.
And really quickly, Gina, we've got about 30 seconds left. I know you mentioned the NVIDIA partnership, but their chips, they're still really expensive. How are you navigating that on the balance sheet perspective of things?
Yeah, I think our strategy really has been about using domain-specific large language models on the data within our platform. And so that actually means that it's a little bit lower cost than some of the bigger hyperscalers. And so from our perspective, we've been able to manage cost pretty well and expect to be able to do so in the future.
Gina Mastantuono, always great to have you. Thanks so much for taking the time to join us. ServiceNow.
Thanks so much for having me.
Thanks, Gina. Keep right here on Yahoo Finance. Much more of your market action ahead. You're watching Morning Brief.
Salesforce built its fortune by disrupting software as we know it. Launched at the height of the dot-com bubble, the company ushered in a new era of delivering software over the cloud, pushing legacy companies out of business.
Agent Force.
Now the tech giant is facing its own disruption brought on by artificial intelligence, and it's turning to Clara Shai to shape its future.
I love to work on the forefront of disruption when it hasn't been figured out yet.
Shai has a reputation for being one step ahead. She built the first business application on Facebook at 25 and started her own company, Hearsay Social, at 27. Now she faces her biggest task yet, transforming Salesforce into an AI leader.
Seems like customer data thieves are everywhere these days.
Salesforce is in the midst of a reinvention centered around artificial intelligence. It follows a rough patch coming out of the pandemic, where software demand slowed, revenue growth declined. The company, once known for turbocharged sales and timely acquisitions, faced questions about its future. But Salesforce is pivoting in a push to put autonomous AI agents at the forefront of customer interactions. That's elevated Clara Shai to the driver's seat as CEO of Salesforce AI.
What did you envision when you took on this role?
In the pandemic, you had this huge supply-demand mismatch where you had a ton of customer service issues, especially if you were in hotels, airline companies, hospitals, financial services. At the same time, that a lot of contact center reps were quitting in droves or cutting back their hours because now all of a sudden they had to take care of their children or their elderly parents sheltering in place. And so it really pushed customer service into using more AI. And so by the time ChatGPT came out in November 2022, we were ready.
That cutting-edge chatbot developed by OpenAI gave the world the first glimpse into the potential of generative AI, launching a tech arms race. As tech companies scrambled to develop their own AI products, Salesforce turned to its trove of customer data, something CEO Mark Benioff has hailed as the company's single biggest advantage. At its annual Dreamforce event in 2024, Shai spearheaded the launch of a new fleet of autonomous agents called Agentforce, with the platform allowing companies to build customized digital agents that interact directly with customers.
Einstein, what do these blinking lights mean?
Salesforce is touting the technology as the third wave in the AI transformation.
What an agent is when you start to use the AI, not just for a single task, write me a sales email, summarize this call transcript, but actually an agent that can think and that can come up with a plan of action and then take action. So it's a difference between asking an AI in level 1 to write a sales email versus asking the agent to help you hit your number, hit your quota for the year. And then the agent figures out, okay, what are the steps that I need to take to hit the quota? It goes from being a single step, prescribing, almost micromanaging what the AI should do, versus asking the agent to figure out what it needs to do.
In many ways, Shai's always positioned herself at the forefront of change. An immigrant from Hong Kong, her family moved to Akron, Ohio at a young age. Her parents took on new careers to make ends meet.
Their English wasn't great, and so we started over, and they did whatever odd and end jobs they could find, shoveling snow in the driveway of our apartment complex, just whatever it took. And I think it taught me, number one, humility, and that, there's no entitlement, right? It's like you do what it takes to take care of the people that you love. And two, it taught me the power of hard work and hustle.
The rise of social media fueled that drive during Shai's first stint at Salesforce. When Facebook took off, she developed an application that allowed users to integrate their social media network with their business contacts. That same year, she wrote a best-selling book forecasting the social media revolution. At 27, she founded her company Hearsay Social, guiding financial services and insurance companies how to use social media in line with compliance and regulations.
It feels like your career is all about sort of staying a step ahead. And I wonder where that drive comes from. It almost feels like you didn't want to fail in any way. You were afraid to fail. I mean, what drove you there in your 20s?
I mean, I've failed a lot too. That's not on my resume, but I think that's been part of my learning. And for me, my parents gave up everything for my brother and me to come here. And so I just feel like the least I could do is to work hard and to seize every opportunity. And that's really how I've tried to live my life.
Did you enjoy being a CEO, a founder CEO? Did you enjoy leading the company?
You know, I didn't enjoy it at first. It was a very new muscle for me, and I had founded a company not to become a CEO, but because I was really passionate and had a lot of conviction around the idea that we were building. And so I found myself in this role where others had expectations of me, and I realized that I had to step up, and I had to be a leader. And it was a tremendous, painful at times process.
Are there any parallels between what you saw back then, particularly with social media, and what you're seeing today with artificial intelligence?
When these big disruptions happen, there's a quote that, the future's already here, it's just not evenly distributed. It's like sometimes, I feel like I see, and there's a number of people here who see this future that is going to be agents everywhere, billions of agents deployed across businesses, but not everybody sees it yet.
Are there lessons that you take away from how you saw that transformation unfold on the social media side to where it is today on the AI side?
Yes, I think that the lesson is to have conviction. I had a lot of self-doubt the first time around, and I was like, well, if no one else believes this is true, maybe I'm the one who's crazy. But just to have conviction and just to keep experimenting, because no one knows exactly how it'll play out. But if you start to play in that general zip code and you start experimenting, eventually you'll stumble upon product market fit. And then that's when the rocket ship takes off.
That climb is already underway, according to some on Wall Street. Analysts at Wedbush Securities estimate AI products will add more than $4 billion to annual revenue at Salesforce. But the company faces stiff competition from Microsoft and other enterprise cloud providers. There's also the question about regulation in the absence of safety measures setting guardrails for AI models today.
Well, when I look at those risks that we talk about, so much of the risk is really on the consumer side. Because on the enterprise side, you can control it more, you have trusted enterprise data, you have someone who is responsible, and frankly, it's in the brand's interest to make sure that everything is accurate and trusted. You don't have those same safeguards naturally built in on the consumer side. And so I think that's really where we need regulation, is to think about who are those bad actors, how are they potentially manipulating public opinion.
In the future, how many of our interactions are going to be driven by AI?
I think an exponentially growing number of them. And I think it's similar to asking the question maybe in 1998 of, in the future, how many of our interactions will be through the internet or some sort of digital medium?
When you've got a machine, a system that can do what you have done for many, many years, does that mean the bar is that much higher for humans in terms of performance and what they have to bring to the table?
I do. I think that every generation of technology has made humans better. And it's meant that humans can start at a higher level, and what that would mean for education, especially for a lot of the lower income parts of the world today where people don't have access to well-trained teachers in schools.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. So let's get started. First up, Hermes shares ticking higher. The luxury brand reporting third quarter sales up over 11%. Chinese consumers still spending at Hermes. That's in stark contrast with the luxury competitors in the space, the likes of those including LVMH and Kering, who have taken a hit from the country's economic slowdown. Bernstein with a note this morning saying they see Hermes as the best current opportunity to protect your portfolio from a global cyclical slowdown exacerbated by those issues in China. And you can see that protectionary stance on this name in the stock price this morning.
All right, let's take a look at Intel. Shares are rising this morning. The chip maker winning a legal battle against the EU's top court. You're looking at gains of just about 1%. The court ruling that regulators can't reinstate a $1.1 billion fine against Intel for a long-running case over alleged anti-competitive practices. Now, this case goes back to 2009 when the EU issued that fine for accusing Intel of allegedly illegal sales tactics to shut out the smaller rival AMD. So again, this court ruling today dismissing that appeal from the European Commission. Obviously a victory here, a win for Intel.
All right, well, semiconductor company SK Hynix shares in the green after posting record third quarter profit and revenue. The results thanks to strong demand for its high bandwidth memory chips used with NVIDIA processors for AI, and SK Hynix is the main supplier of those advanced chips to the chip giant NVIDIA. Those higher chip prices from SK Hynix leading to that record revenue surging 94% from a year ago, continuing their growth after turning a profit for the first time in the first quarter of this year. Shauna.
All right, well, that does it for Morning Brief, but keep it right here. We're just getting started. We've got a full another hour. Coming up next, we've got Catalyst. We've got more analysis on what exactly is driving today's market action. We've got that for you in just about 3 minutes. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, all eyes on tech stocks as Tesla's earnings lift the sector. We'll push ahead to what to expect from the rest of the Magnificent Seven names.
Plus, we sit down with the CFO of UPS as the company surges on strong results. And we hone in on the airline sector as Southwest reaches an agreement with activist Elliott.
And we'll break down the costs of the election on both sides of the aisle. And Elon Musk reiterating his interest in a role at the White House. We'll break down the potential conflicts of interest.
Boeing's largest union rejecting the latest contract offer, extending the strike that has so far lasted over a month. 64% of the 30,000 workers voting against the deal. Joining us now is our very own Pras Subramanian. Pras, obviously just another challenge, another hiccup in the road here for Boeing.
Yeah, 64% better than the last prior vote, and this deal had a pay hike of 35%. So, better vote tally than before, but still a long way to go. Boeing's union members here are pretty upset about the last deal, and they want to extract more. They're also vocally complaining about the fact that Boeing had a tremendous amount of buybacks, they say, during that time frame of the last contract. So why does that money come to us? So that's sort of where we're at right now. Now, management has a lot of convincing sort of to do here with getting people on board. New CEO Kelly Ortberg got his hands full right now because he's got two things, right? He has the pressure from the government coming down on him from a safety and regulation point of view. He's a labor deal kind of not nearly in place yet. And meanwhile, public trust is at an all-time low for the company. That's sort of what's happening here. And that's why the union can feel they have the upper hand here with extracting more from Boeing.
Yeah, and I wonder if that's part of why we saw that lift in support from union members, but it wasn't enough to get over that 51% level. I do want to switch gears while we have you, Pras, because we can't have you on and not talk to you about Tesla, right? We got those earnings over the last 24 hours here. The company is on track to add as much as $80 billion to its market cap. What do you make of the bullishness surrounding this earnings print, and how do you think Tesla can continue that heading into next year?
Look, it was, in my opinion, a news-heavy earnings release and also conference call there with investors. A lot to go through, right? So obviously, profit beat here, very nice, improving margins. People very happy about that. But also, Tesla said they had possibly for a slight growth in volume this year, which means a big 4Q is coming. And then also, Elon said in the call, he sees 20 to 30% possible volume growth next year. So I think a lot of people grabbed onto that as a very kind of positive thing. They talked about the cheaper EV, right? Now, they say it's coming, and it's not going to be the $25,000 car people think it is. Elon said that's the Cybercab. This car will be a cheaper EV. Maybe it's going to be 30 to 35. They didn't say, but that's what we're expecting to see. Coming cheaper than the Model 3. Also, they said they're testing robotaxi ride hailing in San Francisco, which is kind of a surprise. It's actually happening. Tesla employees are doing the ride hailing right now, and there's a safety driver driving. Now, here's the thing. There's no video evidence, there's no documentation, there's no pictures of this, so we want to see that actually in action before we can actually say this is happening. Finally, they said energy storage business was doing quite well. Yeah. It's growing, super high margins, and it's going to double next year is their expectation. So I think there's a lot of little elements there that are really driving the stock here today up a lot right now.
All right, Pras, thank you so much. Really appreciate you joining us to break down those earnings. Appreciate it. Well, Tesla wasn't the only big tech name we got results from on Wednesday. IBM reporting mixed results, showing growth in software and AI demand, but softness in other parts of the company. The stock is under pressure this morning following those results. So what does this signal about expectations for the rest of big tech as we hear from companies like Apple, Amazon, Microsoft, and Meta, all set to report next week? Joining us now to discuss, we've got Daniel Morgan. He is the Senior Portfolio Manager over at Synovus Trust. Daniel, great to have you on here. So what is your expectation as we head into those rest of the Mag 7 minus NVIDIA next week?
Well, it's kind of interesting because you reflected on that IBM number, and the IBM number wasn't bad. They obviously missed on revenues, but I think the expectations coming into that third quarter report were extremely elevated. You had the IBM shares trading at over 25 times earnings. Historically, that stock was trading anywhere from 15 to 20 times earnings. So it's really kind of a mixed report because they did say they generated about $3 billion in revenues directly from generative AI. And of course, everyone's really focused on that. So now we roll into next week, Obviously, we have a huge numbers coming out a week from today, Halloween, with Amazon, Apple, and Intel. Those will kind of dictate what's going on. Alphabet is also kind of sandwiched in the middle there. So next week will be a good indication of what's happening in regards to the FANG stocks, the Magnificent Seven, in terms of the tech sector.
How much can we glean from what Tesla reported last night? Does that really dictate, does that tell us anything about what we'll likely hear from the rest of the Mag 7?
Well, I mean, they're in that group, and quite honestly, it sounds kind of strange, but I don't actually follow Tesla because it's not really a technology stock, it's an automaker, but they're kind of clumped into that Magnificent Seven, into those big tech momentum names. And, you know, as your previous guest was saying, it looked like the Tesla numbers should be very good. There's a lot of good momentum coming into in terms of this reporting quarter. So I think that should roll into next week in terms of a positive light in terms of those big tech reports that we mentioned.
Dan, should they be lumped in with those other names?
Personally, I don't think so, but that's my own opinion. I mean, I'm an old line tech guy. I've been in the tech sector since 1990. You know, I remember the Four Horsemen. We didn't add an auto stock in there back with, with Cisco, Intel, Dell, and Microsoft. And then we got the FANG with the N and then FANG with the Microsoft. Again, they're all tech stocks. But then we created the Magnificent Seven because we had to get NVIDIA in there. We didn't have a better way to do it. And we wanted to get Tesla in there. So personally, I don't see how Tesla fits into that group. But to me, they're an automaker. But they seem to be rolled into the tech group.
Yeah, they do seem to be rolled into that, and I guess Elon Musk likes that so long as you believe in the full self-driving car push moving forward. I want to broaden out a little bit because you mentioned in your notes that the macro picture historically has led the tech sector. Does that continue to be true in a world with NVIDIA?
Yeah, definitely so, because, you probably remember, a year and a half ago when the Fed started tightening in terms of interest rates, everybody was worried that we were going to go into a potential recession, right? And then CIOs would cut back on their budgets in regards to the amount of money that they'll spend towards tech. And it's 100% true. I mean, when we see a downturn in the economy, the first thing to go is tech spending. But what we've been able to see is really what we call kind of I call it a no landing. It's not even really a soft landing. I mean, we're going to get GDP here coming out in the next week or so, and it's probably going to be around 3%. We know the non-farm payroll numbers were north of 250,000. So we've had a lot of good positive economic data despite the fact that the Fed, went through this major tightening cycle. So that all bodes well for tech because everyone's like, well, no impact on budgets. Looks like the CIOs are going to keep spending, and they have. So that's led to strength in the tech sector. So that fear has gone away. And that's one of the reasons why the tech sector has done so well.
But Dan, has it maybe gone away too prematurely, just given the fact that there is still there is still so much uncertainty out there, and there is this real risk that we could see a bit of a scaling back here when it comes to some of that spending?
That's true. And if you look at the estimates going into next year in regards to GDP, we're looking for GDP to slow down about 1.5% to 1.8%. So we may see kind of a residual impact from the Fed, a delayed impact, let's say, 6 to 12 months out, where we do start to see slowdowns. And we did see some indication of that on the IBM report, because some of the comments that came out by the CEO was that he felt that, one of the reasons why they fell up short in their consulting segment was the fact that CIOs are using money that would have been designated for consulting, and they're moving that into AI. They're not populating both. So we are seeing little bits of evidence that we may see some slowdown, but guys, I was around in 2000, and I remember when the siphon just turned off after probably around June of 2000, going into that fall, and it was pretty bad. And going into that following spring, I mean, it just ceased to exist in terms of spending. So when the siphon gets turned off, it's pretty bad.
What is the one thing investors should look for to indicate that that spigot is going to get turned off?
Well, you can follow the Gartner reports that come out. They actually monitor the surveys of different CIOs to see what their spending habits are going to be. You'll obviously see them in the earnings reports and comments coming out from CEOs. I don't expect, though, to have that kind of situation happen anytime soon. You have to remember, we were rolling out with a major translation in terms of concerns about moving into the year 2000. All the software code had to be rewritten. We had all these other trends that were coming through in terms of the internet and so forth, that were starting to slow down. And then all of a sudden, we had that drop off, where now I wouldn't expect that to happen. And these companies, because they have such a tremendous amount of cash on their balance sheets, I believe Apple has over $200 billion in cash. They're not going to go extinct if we see a big drop off in spending. They'll still continue to go.
Daniel, what's your best bet, your top pick in the tech sector right now?
Ooh, that's a tough question. I mean, coming into these reports, you know, in terms of expectations, you know, NVIDIA is kind of an off-Broadway report, right? They're going to come, I believe, in the middle of next month. But I think of those Magnificent Seven stocks, they would be probably the one that would be geared towards the most amount of growth. You know, we're still seeing mature growth cycles coming out of companies like Alphabet. We're still waiting for the holiday season on Apple. That'll come at the end of this upcoming calendar year, fourth quarter. Amazon is still coming kind of out of the woods here a little bit. So of that group of stocks that we're talking about today, they're probably the best position.
All right, Daniel Morgan, great to have you. Thanks so much for your insight here this morning. Synovus Trust, a senior portfolio manager. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. Jobless claims coming in lower than expected today, easing some of the fears that the recent uptick was a sign of further deterioration in the labor market. However, when you take a look at continuing claims, those increased to nearly 1.9 million, the most in almost 3 years. This data coming after the Fed Beige Book earlier this week pointed to a softer view of the U.S. economy, and that, of course, comes in contrast with some of that most recent hard data. For more on where things stand, we want to bring in Paul Krugman. He's an economist, New York Times op-ed columnist and recipient of the 2008 Nobel Memorial Prize in Economic Sciences. Paul, it's great to have you. Thank you so much for taking the time. I threw Fed in there because Fed is obviously top of mind when we're talking about the economy and trying to figure out where things stand. I'm curious from your perspective, just given the conflicting economic data that we have gotten, what shape do you think the economy is in right now?
Overall, we're in great shape. We're coming, ask me again after we know who won the election, but we're coming in fundamentally, inflation has been defeated. There is no recession. So we're now really talking about things at the margin. Is the economy slowing? High frequency data can tell you pretty much whatever you want to hear. What will the Fed's pace of rate cuts be? It's going to depend on, this hard to interpret data and maybe what they had for breakfast. So fundamentally, we went through this great cycle of high inflation and fears of recession, and we came out the other end in a really pretty good place.
So, Paul, are we in the middle of a soft landing in your view?
Oh, yeah. I think that if you really try to look through all of the data issues, the seasonal adjustments and so on, we basically soft landed almost a year ago. And we're basically been in that place ever since.
So, Paul, then I guess how much is riding on that next rate cut? Would it be a mistake? Could the Fed, if the Fed were to stay on the sidelines in November, would that jeopardize maybe how much progress has been made?
Any individual rate decision doesn't make that much difference. The interest rates that matter for economic activity are long-term interest rates, which depend upon the whole expected future course of Fed policy, not on what it did in a particular meeting. And you can see that the impact of that jumbo rate cut on long rates was, kind of transitory because then the economy looked a little stronger, whatever. So I don't obsess much about what the Fed will do at its next meeting. Unless the environment changes radically, which could happen from the election, but unless the environment changes radically, it's hard to see that the Fed won't continue to cut rates over the next year or two because inflation is looking pretty solidly on track to the Fed's target.
How much control does the Fed have over the economy with the two levers they have at their disposal? And I ask in the context of what we're seeing in 30-year mortgage rates ticking up despite that 50 basis point cut. To what extent does monetary policy have the ability to help out folks who are just not able to afford homes right now?
Well, in the end, the Fed is, I'm going to sound like an economist here, the Fed's an endogenous variable. The Fed responds to conditions. And we're seeing mortgage rates, long 10-year rates ticking up, partly because of the economy's perceived strength, partly because of concerns about greatly expanded budget deficits. Sorry, I don't mean to be political here, though obviously I am, but if you look at the Trump program, it's kind of like pandemic 2.0. It's we're going to reduce the labor force with mass deportations. We're going to provide a major inflationary shock with tariffs. So if you think that there's a substantial chance of that happening, of course it's going to drive up long-term interest rates. That's not saying that the Fed doesn't matter. It's saying that people think that the Fed will respond to possible big changes in the economic environment.
Well, Paul, you've teased this a few times and you briefly mentioned it there, but the election and the outcome really could have a substantial impact in your view on the economic direction, on the economy going forward. And I want to bring this up in the context of a new Wall Street Journal poll that was just released and was comparing the Harris agenda versus the Trump agenda and asking voters, the survey here, who they trust the most. And what was interesting, and I know you're going to disagree with this, is that voters appear to have adopted a more positive view of Trump's agenda and past performance, more negative views of Harris, and specifically having a bit more confidence in Trump's ability to handle the economy and inflation. What's your reaction to that? What do you think? And I guess how big of a concern is that for Harris with less than 2 weeks from the election?
Well, different polls are giving you different stories there. And we all know that the polling is an exact art, and I have no idea about the electoral consequences. Some polling suggests that it's a dead heat on the economy and inflation. Others are saying Trump with a large advantage. The economists, both academic and business economists, are overwhelmingly of the opinion that Trump will be much worse for the economy, especially on inflation. I mean, one survey from University of Chicago found that 70% of the economists surveyed thought that Trump would do worse for inflation. Only 3% thought that Harris would do worse for inflation. So the public's views are very much at odds with what people who actually have looked at the policies believe. But of course, people don't do economic analyses. People have memories that there was pre-pandemic and Trump was president and inflation was low, and people were really very shocked by what was in the end a fairly brief but really surprising bout of inflation under Biden. So who knows?
Well, one group that maybe knows at least how they're feeling right now is CEOs surveyed by the conference board this morning, talking about increased pessimism surrounding both the potential impact of tariffs and corporate taxes. So I wanted to get your take on kind of the differing impact between those two. Which do you think could have a bigger impact on the broader economy? Because you talk about tariffs being inflationary, but could increased tax cuts for corporations potentially have the opposite impact?
Well, we've seen what happened. We had substantial corporate tax cuts in 2017, and it's just not obvious in the data that they had any impact. Now, maybe there's something in there. Maybe maybe if you squint hard enough, there's some impact on business investment. But in general, the evidence suggests that corporate tax changes in the range that we're talking about do not actually do much to move business investment, do not do much to move the economy. On the other hand, we're talking about the tariff issue is enormous. We're talking about a radical break, not just with recent economic policy, but a radical break with 90 years of U.S. support for an increasing trade. We're talking about an inflationary shock that is bigger than almost anything else that you could do through federal policy. So the tariff thing, and when you combine that again with mass deportation, those would be really, really big negative shocks to the economy.
Paul, before we let you go, I would love to get your take on one of the big headlines out this week in regards to the election and maybe ultimately how some of the administrations could be shaping up. And the latest report being that potentially JP Morgan CEO Jamie Dimon, he could be interested in joining Harris's administration. Lots of talk about potentially becoming Treasury Secretary. I'm curious, what are your thoughts of him potentially in that role?
Well, it's a funny thing. He's a great businessman. I'm not sure that means he would be a great Treasury Secretary. They're very, very different skill sets. I mean, thinking about it, when was the last time we had a genuinely great business person as president? And the answer is, well, Herbert Hoover. So I'm not sure. I think that Dimon does a great job in his job. I'm not sure that I would think that he necessarily has the quite different set of skills that are required to be an effective administration economic official.
You think he'd make a good president, Paul?
Oh, well, again, Herbert Hoover, right? I had no idea. But look, this is not going to happen. The reality is that maybe, I shouldn't say that. What do I know? But look, there are different spheres. Politics is one thing. You would not want me as a politician, right? Economic policy is another thing. Running a major business is another thing. There's no good reason to think that because somebody is good at one of these things, that they're going to be good at the other things. And this is a repeated delusion. We tend to assume that if you've made a lot of money, that you can be great at other things, and that is clearly just not the case.
All right, Paul Krugman, thanks so much for joining us. We really appreciate your time.
Thank you.
Coming up, we're looking at some trending tickers and talking to the CFO of UPS as the company sees a return to growth. That's next right here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's what the Yahoo Finance's trending tickers page. First up, Capital One results due out after the closing bell today. This as the company's proposed $35 billion acquisition of Discover Financial Services is being investigated by New York Attorney General. Now, James is saying that the deal would have, quote, significant impact on consumers in the state. The Justice Department has already been reviewing the proposed merger. You're looking at actually both stocks versus some of the losses that we saw initially on the heels of this report. Now, both just barely trading above the flat line. Ultimately, what this would mean, KBW, their analyst there that covers these names, was out with quick reaction saying that he doesn't think this case is necessarily a make or break it for the deal in order to get regulatory approval. Maybe that explains why we aren't seeing a bigger reaction in the stocks here this morning. But in terms of why this could make a lot of sense for both companies going forward, or why maybe some investors, shareholders would be cheering this deal or wanting it to push through, Citi's Keith Horowitz coming out saying that Capital One's announced acquisition of Discover has some very compelling strategic merits in terms of marrying that payment network with a top-tier card issuer with leading-edge technology. So again, very much the street had been encouraged by talk of this deal, but of course, this could be a potential roadblock in how this proceeds.
Absolutely. And the Justice Department has already been reviewing that proposed deal. This is the latest probe in terms of New York taking a look at the deal. Having said that, to add just a little bit more context, the proposed merger was the biggest in the world when it was announced back in February. At the time, we had some comments from the CEO of Capital One saying it was a singular opportunity to bring together these two companies that can compete with the largest payment networks. It'll also be interesting to see just in general how the regulatory space changes, perhaps on the heels of that November election, whether or not that could have any potential impact on regulatory pressure on both of these names moving forward. Next up, Keurig Dr. Pepper's third quarter results in line with estimates. You can see those shares down nearly 5% right now. The CEO saying the company remains on track to achieve its full year outlook. Also, the company striking a deal to acquire energy drink maker Ghost for about $1 billion, planning to initially take a 60% stake and acquire the remaining 40% in 2028. I think the pressure that we were seeing on the stock here is third quarter organic sales growth missing Wall Street's expectations. We saw a huge drop in deliveries for their pods that they're offering for any of those K-Cup lovers out there. Those pod shipment volumes were decreasing significantly over the course of the past few quarters and year over year here. I think it's interesting to see this acquisition coming in, potentially moving forward with Ghost Energy. Is that a hedge against any caffeine sales declines that they are anticipating coming up here?
It could be, and we've seen a lot of Keurig Dr. Pepper's competitors get in this space. We know it's been a priority when it comes to some of the moves that PepsiCo has done over the years, and now we see this deal happening. So I think you think that maybe this is a bet that this could offset some of the weakness that we are seeing within the coffee side of this business. I think going forward, the big question for analysts is how big of a growth opportunity this is for Keurig Dr. Pepper and how much ultimately Ghost is going to add to their bottom lines. Again, this deal worth about $1 billion, I believe, and when you take into account the fact that it's expected to close in late of this year, early next year, some questions about how quickly it will be able, or it is going to add to the bottom line. But again, shares on the move here today on the heels of that disappointing print that we got out from Keurig Dr. Pepper. Finally, UPS reporting results this morning, topping quarterly profit estimates, raising its full-year adjusted operating margin forecast as volume growth rebounds. This marks the first time in nearly 2 years that UPS posted year-over-year revenue and profit gains. The stock now up just about 5%, had been up about 10% earlier today, marking its biggest one-day gain since February of 2022. The street obviously very excited by what they heard from UPS this morning. Let's talk about that and more with UPS CFO Brian Dykes. Brian, it's great to have you here on Yahoo Finance. Thanks so much for taking the time to join us this morning. So let's talk about the most recent quarter. We're seeing some of that excitement play out on the street. What does it tell us just about whether or not maybe last quarter was the bottom for UPS?
Well, first, thank you very much for having me. It's great to be here. And yeah, you're absolutely right. I think we said at the end of the second quarter that we had turned the corner and we're returning to both revenue and profit growth. And that's what we showed in the third quarter. And it really is the outcome of a lot of effort to focus on revenue quality and growing the business and the segments that really matter to us. So it's a great outcome for us.
At the top of the call, your CEO, Carol Tomé, was talking a little bit about sales growth slowing in the U.S. over the course of the quarter, but saying the macro environment did not prevent broader growth. When you look ahead, how does that not lead to any potential concern moving forward? How are you thinking about the potential negative impact the macro environment could have and how to adjust around that?
Well, and I think it's a great point. And what we are seeing is when we set out an update to our guidance in July, we have seen some pullback in our customers' expectations for peak season deliveries since July. Now, it's still going to be growth year over year, but we have a very compressed peak. You know, we've gone from the longest possible shipping window between Thanksgiving and Christmas to what we'll have this year is the shortest possible shipping window. And I think as customers are calibrating how they're going to plan their demand and shipping patterns for that, we've seen those forecasts come in a little bit.
Right, when you take a look at UPS now onboarding the USPS air cargo business, you took over that from FedEx at the end of September. What can you tell us just about in terms of how this is progressing and how quickly you expect that to become profitable?
Oh yeah, so absolutely, the onboarding has gone tremendous, but I'll tell you, it's a huge effort. We're taking on nearly 300 million cubic feet of cargo in a very short span of time, and so we did build up our network as we went through the third quarter to handle that. As of October 1st, that's fully transitioned. It's been a great transition both with the UPS team and the USPS team. We just had a peak review yesterday with the USPS, and we're looking forward to the opportunities that it creates. We expect this business will be an attractive margin going forward now that we've fully onboarded it.
Looking ahead as well, I am curious about the holiday season, which is, of course, critical to the business. We have a very short holiday season this year. The days between Thanksgiving and Christmas are smaller than typically occurs in terms of the shopping days available. How are you thinking about that?
Well, so peak is our Super Bowl around here. So, UPS starts planning at peak in February, and we are starting to ramp up our staffing to be able to support our customers during what will be a short holiday season. But we continue to invest in technology that allows us to, one, hire faster and more efficiently, allow those resources to be more efficiently, and we've altered the model. So we'll be using more helpers, more part-time drivers to help manage the flex up and down, as well as the technology that we use within our hubs. We now flow 63% of our volume through automated hubs that allows us to very dynamically reroute volume around weather events or centers that get overloaded so that we can manage the volume effectively and deliver what we think will be the 7th consecutive #1 service peak in the industry.
Brian, many investors, shareholders alike, take a look at your earnings spread and really use it as what it's telling us more broadly speaking about the macro economy. And going back to the point maybe that Maddie made before, I guess, are you at all worried that we could see a slowdown here in the macro economy? And I guess how would you then further adjust maybe some of those timelines or some of your guidance as a result?
Yeah, so I think there's the macro forecast for holiday sales are all over the board, right? It's anywhere from 2% to 11% for what economists think. And unfortunately, we don't have the ability to be an economist. We have to plan for the volume. So what we think is happening is that consumer generally is still strong, but the retailers are trying to figure out how they're going to manage this compressed holiday season. And many of them believe that because it's so compressed that more consumers will go to the store. That's adjusting their shipping patterns. Now, what we do at UPS is we make sure that we've got the variability in our staffing and our capacity to handle it if they do need more. But we staff to what we think is going to be the real outcome for shipping patterns through December.
Brian, a lot of people, and we were talking to your team getting ready for this interview, and they brought up a great point that a lot of people, when they think about UPS, they more so think about the retail consumer aspect, but you're very heavily exposed, obviously, in the B2B side of the business. So I'm curious, are you at all seeing any sort of discrepancies or any sort of differences in the performance of the consumer side versus what you're seeing on the B2B side?
So, our B2B business has been lagging as we've been coming out through this year of recovering from the contract. And we actually saw B2B in the U.S. go positive in the third quarter. And particularly our SMB B2B business grew by 3.8%. Now, that's higher than the market forecast, but it's really built on capabilities that we've launched. We've launched new products. We've launched RFID technology, things that are enabling us to win more and win new in the B2B segment. I would also say internationally, we're seeing B2B growth. Our international business is now growing in 13 of our top export countries. All regions grew revenue internationally, and we're winning in healthcare and high tech that's driving air business both domestically and internationally.
Yeah, you mentioned healthcare, so I want to jump in on that because I know you think of that as a growth area moving forward. What do you think is UPS's competitive advantage in that space?
So look, healthcare supply chains are incredibly complex, right? And that's where UPS is at its best. It allows us to leverage the multiple asset verticals that we have. So if you think about healthcare shipments that are manufactured in China, in India, that need to be flown to the US and go through customs brokerage, stored in a temperature-controlled warehouse, packed in temperature-controlled shipping, and then delivered to pharmacies and households. All that has to be wrapped in a quality assurance system that allows you to have end-to-end visibility and make sure that those drugs are delivered safe and on time. That's where UPS is at its best. It allows us to leverage the multiple pieces of our business at scale to deliver very, very complex supply chains.
All right, Brian Dykes, we got to leave it there, but really appreciate you joining us on the heels of those earnings results. Thank you so much.
Thank you.
American Airlines and Southwest Air reporting earnings today. We're going to break down everything you need to know from those reports right after the break. Stick with us.
American Airlines and Southwest both reporting earnings this morning. Both beat expectations for the third quarter and provided upbeat full-year outlooks, but not all positive news. As you can see, Southwest shares off just about 4%. For American Airlines, they reported a $149 million quarterly net loss. Southwest also reported falling profit for its last quarter. To discuss, we want to bring in Stephen Trent. He's Citi's managing director. Stephen, it's great to have you here on set with us. Let's talk a little bit about what we're hearing first with Southwest, because a number of headlines. You have the earnings that we just went through, the 4Q guide really dragging on the stock, I think, today. You also have the settlement here with Elliott. I'm curious, how does that then fit into your outlook here for Southwest? And are you maybe a bit more optimistic that now that we have this settlement with Elliott, Southwest management can get back and focus on this turnaround at play?
Yeah, sure, and thank you for having me on. I think in the terms of Southwest, one of the things that stood out to me was the 4Q ex-fuel seat mile cost guide. That did look heavier than we were anticipating, and I would say that's at least partially behind the price action this morning. You know, the Elliott, that whole situation with them is not 100% surprising how this ended. And I think given the headwinds you see with discount airlines versus network airlines, you know, to go into the company and to say, well, we're going to replace everybody and we'll have a few years of discovery while the industry keeps trending in a tough direction. So it seemed that doing that is kind of untenable in terms of wanting to get a quick turnaround on the stock. But maybe people are now less distracted.
Yeah, I guess I wonder from your perspective, does 6 new directors in the room change the fact that the lower income consumer is struggling and these airlines across the board, it seems like, are having to target higher income consumers, and that's a challenge?
Yeah, great point. You know, throughout the industry, we are seeing seat mile cost pressure, especially for the discount airlines.
Yeah.
Everybody's labor is going up. Nobody can get equipment in a timely manner from the manufacturers. And United States does not have enough air traffic control capability, which is primarily a Northeast and Florida things, but not only those places. So when you think about the fight for higher unit revenue, adding premium, maybe adding some fees and these kind of things, you know, if your business model has been based on selling cheap seats and diluting seat mile cost with high block hour utilization, it's a tough place to start for a discount airline like Southwest.
Stephen, when you talk about the fact of getting Southwest back to those pre-pandemic levels and trying to recapture its pre-pandemic profitability, how attainable is that in terms of, I guess, how long do you expect it to take in order to get back to those levels?
Yeah, absolutely. So I do think we need at least a couple of quarters to see what kind of forward progress the carrier's making. You know, the things that they proposed during their investor day, which I think they proposed some good things. You know, these aren't the kind of adjustments we're going to wake up 2 weeks from now and say, oh, wow, they did it. Mm-hmm. I do think that what concerns me about the long-term guidance is what they're telegraphing about earnings quality. So $4 billion in incremental EBIT by 2027, but total free cash flow of just over $1 billion. So that free cash flow conversion looks pretty poor. You know, if you go back to pre-pandemic, they were doing EBIT and free cash flow around $3 billion each. So why the much poorer conversion now and the earnings quality roll-off? That's a concern for us in terms of them getting back to those levels.
What does it take for these airlines to get to a place where things feel just a little bit easier, right? Like the amount of headwinds you mentioned, pun intended, are so, there's so much hitting these airlines right now. When can things just, and what is the thing that's going to get us back to that calm state?
Yeah, absolutely. You know, I do think that there has to be some sort of rationalization from a capacity perspective, one. Two, especially the discount airlines, we need to get to a point where there's better equilibrium between unit revenue and ex-fuel unit cost. So Southwest in 4Q said unit revenue is going to go up, but unit costs are going up much more. That's probably not something that's sustainable over the long term. Mm-hmm. Network airlines, I think, have a much easier path. So you've actually seen a post-pandemic earnings wallet share gain for them, and probably the likes of United and Delta are probably happy where they are at this juncture.
Mm-hmm. I want to end by asking you about some potential merger news we got this week with regards to Frontier and Spirit. What do you make of that potential deal? How do you think JetBlue is feeling? What's your biggest takeaway?
Yeah, certainly. So I have to be a little bit careful with single stop name mentions, but what I can say on the industry level, if one looks at the amount of supply that's in the system now, there has to be some way of going the other direction. So we're seeing that, for example, with Alaska Air, which I would say is doing a very good job on its own and has interesting opportunities with its merger activity. Mm-hmm. I think on the discount airline side, quite frankly, the devils are going to be in the details. So we know very little about that subsector's forward movement today. And it's going to be interesting to see how it pans out or how it doesn't pan out.
Is it likely to attract some regulatory pressure? I guess, do you see an outcome different than what we saw with JetBlue?
Yeah, hard to say. And I think that's going to be predicated, at least in part, on who's in the White House in January and what kind of posture the next DOJ is going to take on all of this. But certainly, regulators look at things like concentration and market overlap. And what sort of challenges any airline would face from its constituents on the right side of the balance sheet that maybe figuring out or trying to figure out how they're going to get compensated.
All right, Stephen Trent, great to have you. Thanks so much for joining us here in studio. Citi's Managing Director. And on Monday, we will be speaking with Southwest Airlines CEO Bob Jordan. He will join us on Yahoo Finance's morning brief on Monday morning. You won't want to miss that. Coming up, Elon Musk reportedly under fire with the DOJ for his $1 million giveaways to voters. We'll dive into that next on Catalysts. The Justice Department reportedly sent a letter to Elon Musk's America PAC warning that its $1 million giveaway to registered voters in swing states may be against federal law. That's according to a report from CNN. The PAC has already given away 4 checks worth $1 million each to voters in Pennsylvania and North Carolina. Now, it is illegal to pay people to vote, to withhold their vote, or vote for or against a certain candidate. Federal law states that the action may be punishable by a fine of up to 5 years in prison. Now, this is just the latest developments in the story that we have been covering since Musk did announce these plans. We know that there have been several government officials coming out and policy officials coming out against this, just voting their concern about what this would ultimately mean. Pennsylvania Governor Josh Shapiro, he's a Democrat, former AG, a state AG, saying on Sunday that the giveaways were, quote unquote, deeply concerning and deserved legal scrutiny. Musk then posted on his X platform that it was concerning that he would say such a thing. There's been this back and forth going on all week. But again, the latest development here, I think, just shows the fact that there is some concern about these $1 million giveaways and ultimately how that could dissuade voters.
Yeah, for those who've received it so far, I guess the advice is cash those checks before this continues to boil over. But we're going to stick with Elon Musk. Yahoo Finance asked Mark Cuban about Musk's White House ambitions. Here's what Mark Cuban had to say.
And if it's Elon, yeah, he's a great entrepreneur. I'm not going to doubt that or contest that. But he's got a few conflicts. What about conflict of interest? How is the Trump administration going to deal with that? Is Elon going to give up his other businesses? Is he going to say, no, I'm not going to do Tesla. I'm not going to do SpaceX, et cetera, so I can work on this? I don't think so.
For more on Elon Musk's potential conflicts of interest, we've got David Fahrenthold. He is an investigative reporter over at the New York Times. David, it's great to have you on. You've written extensively about Elon Musk's influence over the federal government. If you had to give us one stat, one single biggest thing that comes to mind to kind of showcase that influence, what would you point to?
I'd point to two. One is that he has more than 300 ongoing contracts with the federal government, selling things to the federal government. The other is that he has more than 20 ongoing investigations by the federal government of his businesses. So in both those cases, if he comes in a role where he's now overseeing his customers and his regulators, you can see the incredible conflicts of interest that would result.
David, I'm curious from your reporting, just a concern maybe that you have seen involving this from Elon Musk. And is there anything that you can compare this to in the past, or is this very much almost a new precedent that's being set?
There's really nothing like this in the past. There's been times in the past where presidents have brought in sort of titans of industry to try to run the government like a business, to try to recommend more efficiencies. But those people were never as connected to the government already as Musk is. If Musk is going to truly come in, keep all of his businesses, keep all of his business connections, and then come into this role at the federal government, he's going to be in a place that no one has ever been before, basically a private citizen with the power to oversee his own regulators. So if the FAA blocks a SpaceX launch and he thinks that's wrong, he can now go to Trump and say, you know what, I think the FAA is very inefficient. They should be cut. Their budget should be cut. But he's now going to have power over the people that, in the name of the government, are supposed to have power over him.
You know, David, I'm curious from your reporting, and just given his mass footprint that he does have, is Musk almost going to have just a major footprint in this space no matter who wins? Yes, it might not be a space or a title within the administration, but just given the number of businesses that he has, it almost sounds like regardless, he's going to be obviously a critical figure.
Well, you're right that no matter who wins this election, he's going to have a huge amount of influence over the federal government. And that is most true in the world of space because his company, SpaceX, basically dictates when NASA and the Defense Department launch their satellites. You know, that dynamic sounds incredible that NASA would have to listen to somebody else to know when they were going to launch their things, but that's true. He's going to keep that power because there's nobody in the space that has the kind of operation he does. No one can supplant him. So the idea that if Kamala Harris wins, you know, Musk is going to lose this influence or lose his contracts, it's not going to happen. There's nobody who could take his place.
If he does enter this Department of Government Efficiency role, which he talked about on the Tesla earnings call last night, is the pathway to an approval of something like autonomous vehicles just kind of a given?
I mean, the way that we hear Trump and other people around him talk about his potential administration, the way that Musk himself talks about this role, I think you'd have to think that's what's on Elon's mind, that there's a lot of things he wants approval for from the federal government, not just autonomous vehicles. You know, Neuralink needs FDA approval to put things in people's brains. SpaceX needs all kinds of approvals to launch its rockets. And those are the things he thinks are standing in his way. If all of a sudden he now has the power, whether it's formal or informal, to push back against that and clear his own obstacles, yes, you can see what a huge benefit that would be for him.
All right, David, unfortunately, we have to leave it there. We both really enjoyed your article, so thanks so much for taking the time to join us here on Yahoo Finance today. Keep it right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Alexandra Canal has you for the next hour. We'll see you tomorrow.
Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, tech stocks are in focus after Tesla earnings impressed investors and sent the rest of the sector higher. With more Magnificent Seven names set to report next week, how should investors play the tech trade? We'll discuss. And the Federal Reserve, another key driver for market action. The central bank releasing its beige book Wednesday afternoon. It's only published 8 times a year, so we're going to break down why it's important and the key takeaways you need to know. Plus, the state of the housing market. While existing home sales are on track for their worst year since 1995, new home sales are rebounding. So what does this all mean for buyers? We'll get some tips from an expert later in the hour. But first, we take a look at some of the market action 90 minutes into the trading day, and we're seeing stocks mix. The Nasdaq and S&P are rising, while the Dow ticks lower, down about 0.3%. Tesla, though, is leading a lot of those gains in tech after beating analysts' expectations in its latest earnings results. This coming ahead of reports from Amazon, Apple, Meta, and Microsoft, which will all be out next week. So with the Mag 7 top of mind, how should investors play the tech trade? Joining me here at the desk is Tony Zaparo. He is the CEO of Equity Set. And Tony, let's start there with Tesla. Shares are rallying this morning, but expectations were low heading into this print. So what does it say, if anything, about what we can expect from those other Mag 7 names?
Yeah, absolutely. I think it's a huge surprise to a lot of people with how high it's ripping today. A lot of the good profit numbers being boosted. Revenue shrinking a little. I think it's more of a trade, though, right? Tesla's been a little bit of range bound. It had a big gap down, right, just a couple weeks ago. And so I think from a numbers perspective, it's good for Tesla. I think in the short to medium term, though, it is a trade play. And I think if it approaches and closes high above a 260, 265 level, I think you buy it, because I think it's going all the way to 300. However, if it kind of stops, right, pauses, I think it's going all the way down to 200. And so good prospects for Tesla, increasing margins, increasing profits, declining revenue, going into a questionable environment. I wouldn't go all in on it yet.
Okay, not all in on Tesla. We know it's a pretty volatile name. Is there any read-through we can take from Tesla earnings on what we could expect from a name like Meta or even an NVIDIA later on in the earnings season?
I think you're going to continue to see strong earnings, right? One thing that's been persistent and really hard to make a bear case for is the largest companies and the largest market cap companies like Meta, like Amazon, like all the technology companies as well, they are really doing a number, right? A good number on earnings. They're growing, and I think they'll continue to grow. I think it's how much that price action matches with the growth or growth expectations that is the risk. And so I think, Microsoft, Meta, they will all report very good earnings, right? Especially bottom lines. But I think the thing to watch for is revenue declining, is consumer fundamentals deteriorating a bit, because that's what's going to catch, I think, these stocks off key.
And I want to talk about the market rotation out of big tech into some other areas of the market. It's interesting that you say the rotation has, quote, largely run its course, which is different from other strategists we heard from this week. So why do you think that is, and what does that say or mean for equities down the line, especially since we're seeing stocks hover at all-time highs?
Yeah. I think the rotational trade, and a lot of the trades lately over the last couple months, they've been so fast and so quick to kind of shift, right? Money is going very quickly into certain names, right? Into the China trade, right, weeks ago, into the rotation trade. And I think that fast, that soon, is a little worrisome. So I think it could play out over the next year, 2 years. But I think in the intermediate, it's just too much is propping up these names. And if we see any sort of weakness, right, or people pulling money out, people going to higher yield savings or bonds, right, with the spike in we're seeing there over the last even just week, that's where I think kind of the risk is at. I think there's good names, but I think you have to buy them at 15, 20% off their highs. I think you focused on the S&P, weighted 100, right, and maybe stay away from the top 20 if they're within those ranges. But that's where I think you're not trying to put a lot of new money to work, right? All your life savings right now. I think you have to kind of wait it out and see what happens.
And to that point, you say that value plays that didn't participate in the rally, they may become value traps. So can you define what you mean by a value trap and what names you would avoid at this point?
Absolutely. And that's, I peg myself a bit more of a value investor, right? I like things that seem to be undervalued because they have a lot of price potential going forward, fundamental growth. And so when I'm seeing a lot of the names that haven't participated, right, you're seeing Xerox's, you're seeing even Disney's, right, Nike's, a lot of names that have not participated in the initial rally or the rotational rally. That's where I think, it can't go much lower, right? It's near 52-week, it's near all-time lows. Well, it's got to go up 10, 20, 15%. And I think the reality is if the economy stumbles, and again, just we hit a little bit of a plateau in terms of growth or even some contraction, those names will continue to go lower and lower and lower. So that's where from a value trap, the Walgreens, right? The names that have just been beaten down and are down 30, 40, 50% year to date, those look attractive when a market with so many stocks hitting new highs doesn't look as good to investors.
That's a potential risk. Another risk that I want to quickly hit on is the election. And the polls show that Trump is slightly edging ahead of Harris. How do you view the outcome of the election in the context of markets? And as an investor, should you be repositioning yourself or protecting yourself in any way from that volatility?
Yeah, it's sneaking up on us for sure. And again, neck and neck. And I think that's a risk in terms of, while other patterns might have played out depending on incumbent party coming in, rally continues, right? All these things that have happened in the past, I don't think you can necessarily rely on that. And so I think what you have to do is be defensive, right? No matter if it's Republican or Democrat that comes into office, just with market at all-time highs, volatility increasing, I think it's defend yourself, take a little bit of money off the table, because whatever happens, I think there's going to be some money moving around out of the market, out of stocks, just because we seem to be at such extremes.
So defensive, look for value, but don't fall into those traps. Okay, Tony Zaparo, Equity CEO, thank you so much for joining us today.
Thank you.
Appreciate it. Well, the Fed's latest Beige Book Wednesday pointed to a slowing but stable U.S. economy. Joining me now with the highlights from the report is Catalyst host Madison Mills. And Maddie, let's start broad here. What even is the Fed Beige Book, and why is it so important when analyzing the state of the U.S. economy?
Yeah, Allie, thanks so much. So the Beige Book is a report published by the Federal Reserve that summarizes current economic conditions across the 12 Federal Reserve districts you can see here behind me, and it's published 8 times a year. It's based on a lot of qualitative information, so interviews, questionnaires, instead of that numerical data that we report on every week. So what did we learn from the most recent report? We got a lot of insight into a few key areas of the economy. First up here, labor. Employment increasing slightly during the period. Many districts reported lower worker turnover and limited layoffs, but demand for workers eased a bit as well, with hiring focused on replacing workers that left rather than growing the whole pie. Now, a few districts did note challenges with hiring skilled laborers in certain fields like home improvement and manufacturing as well. Next up, the big one, inflation. Most districts reported selling prices increasing at a slight or moderate pace during the period, but some prices of products like eggs and dairy reported to have increased more sharply. Consumers feeling the pinch on that end of things as well. Now, the Federal Reserve Bank of Philadelphia noted that higher income shoppers, they were actually becoming more price sensitive, following a trend that's already been seen amongst the lower and middle income folks. So certainly something to monitor there. And finally, we've got housing. The report noted that market activity did hold up. Inventory continued to expand in a lot of the nation. That's good news given the importance of housing supply and bringing down those prices. Home values largely held steady, but officials found that some would-be buyers still hesitant to come off the sidelines because of uncertainty just around those mortgage rates and also a lack of affordable housing. Another topic top of mind across the districts, of course, the election. Several districts cited that election as a source of uncertainty or a factor that was causing delays in investing, hiring, and purchasing decisions. The election was noted 15 times in this Beige Book, Allie.
Maddie, thank you so much. It's a great breakdown, especially as we know the economy continues to be top of mind. Appreciate it. Boeing's largest union, which represents over 30,000 workers on the West Coast, voted to reject the latest contract offered by the company. 64% voted against the new proposal, although that rejection is an improvement compared to the 95% who voted against the original contract back in September. Union leaders issuing a statement after the vote saying Boeing workers want to win back, quote, what was taken from them by the company for more than a decade. A few sticking points for the union include a 40% pay bump and the return of the defined benefit pension plan. I spoke to Salvatore Capizzi, Dunham & Associates Investment Council Executive Vice President, on Wednesday about the importance of pensions for these union workers. Here's what he had to say.
A pension plan gives you the certainty. You know the income that's coming in. It's easier to plan. If I have a pension program, then even lower paid workers, they participate. They wind up receiving a benefit once they retire.
Union leaders saying they are ready to resume negotiations immediately. Boeing declined to comment on the vote. Coming up, how should first-time home buyers navigate the housing market? We'll get you some tips from an expert. That's next. We're getting a fresh read on the housing market today. New home sales climbing in September, up 4.1% from August and up 6.3% from September of last year. Joining me now, Alliant Credit Union's head of residential lending, Dan Bauer. Now, Dan, this uptick comes after existing home sales fell to a 14-year low. So what does this all tell us about the state of the housing market and what home buyers are ultimately looking for?
So what this tells us is that housing demand is starting to increase, and we are starting to see a little bit of a lower interest rate environment as a result of recent Fed rate cuts in September, Alexandria. This lower rate environment can lead to lower monthly payments, and by extension, give homeowners more buying power, allowing them to consider options like potentially more expensive homes and more desirable neighborhoods with better features for their families.
And like you mentioned, mortgage rates, the Fed is expected to continue to cut interest rates through the end of the year. But how much of that has already been priced into where mortgage rates are currently hovering, and how much more relief do you think we could see?
So we have seen a lot of the Fed rate cuts priced into the market over the past several months, and we've seen that reflected in mortgage interest rates as they dropped in the month of September. Right now, the market's looking at potentially 2 additional Fed rate cuts between now and the end of the year. And while other economic factors like job claims and housing supply are going to influence the interest rate environment as a whole, we do expect that we'll see mortgage rates continue to see a little bit of relief between now and the end of the year.
So regardless of where rates head in the future, what are some key financial tips you'd give home buyers, particularly first-time home buyers, that hold true no matter how much we see rates fluctuate?
Sure. So as a first-time home buyer, first and foremost, you want to have a plan. And getting pre-qualified to understand your income, your debts, what you're able to afford is critical. At Alliant, we offer a free, no-cost, no-obligation pre-qualification program to assist home buyers in that very endeavor. Secondly, you want to consider adjustable rate mortgages in this environment. Adjustable rate mortgages provide an alternative in high interest rate markets with a lower initial interest rate and possibly the ability to refinance if rates drop in the future. And finally, always evaluate the overall affordability with your long-term financial goals. Creating a customized plan for you and your family is absolutely critical. Working with professionals like financial advisors, like a professional mortgage lender and real estate experts in your market are always fantastic advice for any first-time home buyer.
And Dan, the inevitable question I have to ask, should you hold out for lower rates if you're searching for a new home, or should you buy now?
You know, it's a great question, Alexandra. To be honest, holding out for lower interest rates can be offset by increased housing demand. So if you're in a market right now that's competitive, you have a financial plan that works for you and your family, you've been pre-qualified and you're confident you can move forward, moving forward with that transaction is probably in your best interest at this point. If you wait and hold out for longer interest rates, as mentioned, you might see an offset in increase in housing demand, which could increase housing prices, offsetting some of that benefit of the lower interest rate environment.
And Dan, we often get a lot of data points when it comes to housing. Are there any signs that folks can look out for that signal, you know what, hey, now is a good time to get into this market, maybe besides just mortgage rates?
Sure. So always, as always, when you look at broader economic factors like job claims, like the macroeconomic environment in terms of looking at housing supply, a lot of that's relative geographically across the United States, but home buyers should be mindful of the broader environment. Typically, when we see negative job claim numbers or we see negative economic indicators, that would typically mean lower interest rates. But again, so much of this is market sensitive. So much of this is specific to the market that the buyer is looking in. That as long as they're working with a professional mortgage lender, a professional real estate agent, have a financial advisor in their corner, and they're listening to all those opinions and opportunities to be able to influence their family, they'll be able to make the right decisions for them.
And I'm curious, what type of buyer are we seeing within this weird, wonky market? Is it people that are single? Is it families? Is it folks moving from cities to suburbs? What are some trends that you're noticing?
So we're noticing a lot of trends of people moving from cities to suburbs. That's been a trend that's been in place here for several years. We're also seeing a lot of move-up buyers. Right now, some of the, unfortunately, first-time home buyer markets have been prohibited with the increase in elevated home prices. So home prices have remained high. That's been a prohibitive factor from families being able to enter into the first-time home buyer market, unfortunately. So what we're seeing a lot of right now is families that are migrating from cities to suburbs, choosing ideal geographic locations for them and their family for whatever reasons that may be. And we're also seeing the market reflective of a lot of home buyers that have chosen to move up if those properties become available and the opportunities present themselves in their particular market.
All right, we'll see where this market heads through the end of the year. Dan Bauer, Alliant Credit Union Head of Residential Lending. Appreciate your time.
Thank you, Alexandra. Great to be with you.
Coming up, so your credit card changed issuers. What should you do? We've got tips next on Wealth. If approved, Capital One's acquisition of Discover Financial would create the largest credit card issuer in the U.S. While officials are still investigating if the merger can go through, a possible deal could have big implications for credit card customers. So what happens when your credit card gets a new issuer? Here to break it down for us is Casey Bond, Yahoo Finance's lead editor and content strategist. She covers banking. So Casey, what happens here? And I have a vested interest in this because I am a Capital One credit card holder. So if this merger goes through, what does that mean for someone like me?
Yeah, so when your credit card is purchased or acquired by another company, that financial institution becomes your new credit card issuer. And in theory, this should be a fairly seamless transition. The new issuer will send you a new card with a new number, and that's the one that you're going to use going forward. However, there could be some significant changes to your new credit card account. It's important to note that the new issuer cannot raise the interest rate on your existing balance, but if you make new purchases on that card, they could potentially raise the rate. However, they do need to give you 45 days notice before that happens. Other significant changes to your account, such as the minimum payment, the fees involved, those also require 45 days notice before any changes can be made. As far as less significant changes, such as the rate at which you earn rewards, the new issuer can make changes to that at their discretion without notice. And it's also important to note that when you change issuers, there could be differences in where your card is accepted. For instance, American Express and Discover are typically less widely accepted than Visa and MasterCard. So that is definitely something important to keep in mind.
So if you're someone whose credit card may get a new issuer, what are some steps you can take now to make that transition easier?
Yeah, the first thing that you're going to want to do is make sure that you have a backup payment method, just in case there are any issues with that new card. So that might be a second credit card. If you don't have one, now might be a good time to consider opening one. Or alternatively, you could transfer some extra funds into your checking account and rely on that debit card, again, just in case there's any hiccups along the way in that transition. Another thing you want to do is download your statements and have those saved somewhere. You may lose access to that information once the new issuer takes over. So if you need your statements for tax purposes or budgeting, it's good to have those on hand. So make sure you save them. Another important step to take is to take a look at what rewards you've accumulated, if any. If you have cash back, points, miles, just make sure you know exactly how many you have, what they're worth, so that once you transfer over to the new card, you can make sure that those are still in place and accurate. If you have cash back rewards right now, consider maybe redeeming those ahead of the transition just in case. And then once you have that card in hand, make sure that you go through and update all of your accounts, apps, digital wallets with that new card information. You want to make sure that you don't miss any payments and potentially get hit with late fees or even damage to your credit. And finally, make sure you review the terms and conditions of your new credit card account very carefully. In some cases, there may be benefits that are specific to a certain issuer that you could potentially lose in the transition, but there also may be benefits that you could gain. So make sure you really understand all of the perks of that new account and don't miss out on anything valuable that you may be offered.
Some important advice there. Casey Bond, thank you so much. Appreciate it.
Thank you.
It's time now for our wealth tip of the day. And today we're taking a look at how to play cash in your portfolio, specifically via money markets. First things first, what is a money market account? To put it simply, it's a type of account offered by banks and credit unions. Like other deposit accounts, money market accounts, or MMAs, are insured by the FDIC or NCUA up to $250,000 held by the same owner or owners. Money market accounts tend to pay you higher interest rates than other types of savings accounts and are somewhat tied to the Fed's interest rate decision. For instance, when the benchmark interest rate rises, banks may increase the interest rate on MMAs in order to attract more deposits. But there is a trade-off. Sometimes you'll have a limited number of transfers. Now, this can vary from bank to bank, so check with your provider. But typically, money market accounts will limit withdrawals to just 6 per month. Still, it's important to note that there is usually no limit on ATM or in branch withdrawals, but let's say you do hit that withdrawal limit. You'll face an excessive withdrawal fee or other penalties for each transaction. If you repeatedly exceed the limit, the bank can close your account. Now, when this happens, the bank usually moves your money to a basic checking account, which means your deposits will earn little to no interest. So how do you avoid these penalties and fees? Yahoo Finance contributor Sarah Brady has the following advice. 1, set up an alert to keep track of your withdrawals. 2, move the cash that you need day to day into a checking account, or you can open an MMA at a bank that doesn't charge excessive withdrawal fees. For more tips and a list of banks that don't charge penalties, visit the Yahoo Finance website. Much more on wealth after the break. You're watching Yahoo Finance.
Welcome to Stocks in Translation, our essential conversation cutting through the noisy numbers, the mayhem, and the hyperbole to make it easier for you to find the right investments for your portfolio. I'm Jared Blickery, and my sidekick here is Sydney Freed, as always, and we also have Caleb Silver back. He is the editor-in-chief of Investopedia, and I can't mince words about this. It's a big down day in the market. It's getting a little bit better. We're taping this on Monday, but we want to talk about risk management today, so that is our theme. Great theme for the day. Our phrase of the day is also risk management, and this episode brought to you by the number 5. That's how many rate cuts the market is pricing in by December. Why more rate cuts isn't necessarily something to celebrate. So Caleb, before we launch into our discussion about risk management, just want to get your overview of what you're seeing in the markets right now.
Yeah, it's a meltdown, and a lot of people thought this was coming. We maybe have been overbought, and now we're swinging to the oversold side. We do have those concerns about the economy slowing. You got mixed signals, right? You got good headline numbers when you look at GDP. You got good headline numbers when you look at consumer spending, which is holding up kind of barely, even though consumers feel a little tapped out. But inside the economy, the real feel is not very good. And then we, of course, had that jobs report that was slower, lighter than expected last week, and a rise in the unemployment rate. All of a sudden, the drumbeat around a recession, a slowdown is here, and nobody wants to own risk assets, at least these days. We'll see how long this holds on.
So let's get to our risk management definition here, our phrase of the day. A very meaty topic, so let's just dive in. Risk management involves identifying, assessing, and prioritizing risks as part of a strategy to mitigate the impact of adverse events. Crucial for protecting financial resources and ensuring long-term stability and growth. And so there's a lot to unpack there, and it means a lot of things. What does it mean to you, risk management?
Yeah, protect your downside. I mean, basically, but risk writ large, that four-letter word is so important in our lives, but especially in our financial lives, right? We don't get taught risk in high school. We don't get taught risk in college. It's something we have to learn. When you get into the capital markets and you start to invest and allocate your money, you have to be thinking about your downside. And that really causes a fundamental question to be asked of yourself. How much of a loss are you willing to take? What is your tap out number? Is it 10%, 20%, 30%? And then building your portfolio around that. I am risk averse. I had a lot of financial trauma growing up, and I hate to lose 5 times more than I like to win. So I like to protect myself with a lot of risk balance assets in my portfolio. And for investors, you have to determine that number yourself. What's your sleepless number? What's your tap out number? That's risk management in a nutshell.
So if you're a passive investor and you just have, you might own a bunch of ETFs, you don't own single stocks, should you do anything when there's a sell-off? Should you check your portfolio? Should you sell anything?
You avoid the news, as they say.
Yeah.
Everybody always says, don't look at your 401k. I don't believe that at all. Look at your 401k. It is your money. Know what is in there. So if you're a passive investor, let's say you're a 401k investor and you've allocated towards some S&P 500 funds, some large cap stock funds, maybe some bond funds to balance out your risk a little bit. You should make sure that is in balance. We've had record highs after record highs coming up until the last few weeks. And guess what? Your portfolio is probably a little heavy on the technology side, right? On the S&P 500 Nasdaq side. Well, you're seeing that come down in this big sell-off. So you might want to think about loading into some value stocks that haven't been appreciated so much, or getting a little bit lighter and loading into cash right now, which is still yielding 5%. You can do that, but you can also buy a target date fund, which is what a lot of passive investors do. And those balance your risk as you get older, nearing that retirement date. That's been a popular choice for a number of years. I don't see that going away anytime soon.
On the other hand, though, is it time to buy a dip? If everything's going down and we know that tech has done very well, should you use this as a buying opportunity?
Yeah, for people that have a long-term time horizon and cash on the side, absolutely. Stocks are on sale. The thing about the stock market, and you guys know this well, is it's the only store in town where people run out the door when things go on sale because they're afraid. And I totally get that. But I've been through a few bear markets, and none of them feel very good at all. And corrections don't feel very good either, but I do know that we're always due for at least one correction, a 10% drop or more once a year. I know we're in for a bear market every 3 to 4 years. We haven't had one since 2022. So I know that these things happen, and I know that the first 2 times it happened, I was too scared to do anything. The third time it happened, I backed up the truck. And that turned out to be a great thing for me to do, to buy the dips, but also load in when interest rates were low, stocks were on sale, and that was a good move. But for people who have long-term time horizons, keep buying, and especially when things get lower, definitely keep buying, because then you're lowering your average price, your dollar cost averaging in, and we love when people do that. It's a great Investopedia term, dollar cost average.
You can do this a number of ways, and this is something that Warren Buffett talks about, how to get into the market. You might just automatically have every 2 weeks from your paycheck a certain amount withdrawn, and so that's just going to get you into the market, into your positions, probably a passive investment. Every couple of weeks, you're just going to be adding a bit to it, and your dollar cost averaging, if you're adding as the market's going higher, your dollar cost average is going higher, but you theoretically have those returns to sit on as well. And if the market goes down, well, you can lower your cost basis such that when the market goes up, then you have that. We've been talking about more passive investors and what to do and how to approach these things. What about active traders? Because I know I come from an active trading background. I'm thinking about risk management before I enter the trade. I need to know where I want to get out before I get in.
Yeah, so more advanced investors and traders do this on the regular. They set a threshold before they go into any trade of how much of a loss they're willing to take, and they put a stop order on that number. So if the stock breaches that point, they're out automatically. Also, most traders, most advanced traders, never risk more than 2 or 3% on one individual trade. You talked about diversification. That's how they do it. And P.S., they do most of their trading within a 2 to 3 hour window, probably early in the morning, make their trades. They don't walk away with any money on the table, right? They don't get emotional about it. It is an equation, a math equation they're solving. So they're protecting themselves on the downside. They're mitigating their risk by not going in too hard on any one trade. They know their downside, and they also know at what level they're willing to take a profit, their limit price, for lack of a better word. They're setting that limit as well. So they have their range, and they're trading within the range. They are really good at risk management because you can't be a successful trader and make it to tomorrow unless you have risk management skills.
Yes.
One thing that I helped produce this morning was we checked in on the VIX, the fear gauge. Is this a good time to buy it? Because when I saw it, it was like really high compared to what I'm used to seeing.
Yeah, the VIX or volatility index, the fear index, a lot of people call it, really tracks that fear in the market, looking at put options out for the next 30 days or so. If people are betting against the market aggressively, buying put options against the stock market, you're going to see that VIX rise. Well, that VIX is screaming like a toddler that just dropped its ice cream cone in the park. It is on fire right now, and it's been asleep for like 2 years.
Yes.
So it's up right now. Is it a good time to buy it? No. The VIX is very volatile. You talk about catching falling knives. The VIX is one of them. And also, it's worth noting that the VIX was that measure of fear in the market for a very long time. But then we got 0 days to even options, and there's a lot of traders betting just on a little 8-hour period of stock market activity, and the VIX is kind of that 30-day look. So it's a bigger macro look, but it doesn't capture the intense volatility we're seeing moment to moment during sell-offs like these.
Yeah, I think that's a great question too, because a lot of people think, well, we're in the midst of this meltdown. This would be a great time to buy protection, but in fact, the best time to buy protection is when you don't need it. And that would be several days ago. So it's a little bit late for that, but this conversation is about helping people prepare for the future. So how does this enter your thinking about risk management?
Yeah, well, you mentioned that the best time to buy an umbrella is 3 or 4 days before the rainstorm. You go out when it's raining and they're about $10, $15 a piece. So yeah, it's a good time to always buy protection and make sure you always have that understanding inside your portfolio. A lot of people don't even know what they have. So first of all, know what you own.
Sure.
Number 2, make sure that you have protection. You are so-called hedged so that you're just not all loaded into 5 or 6 stocks. There was so much concentration in the stock market this year with NVIDIA and the mega cap techs and the semiconductor stocks. It was bound to spill over, and that's kind of what we're seeing here. Those stocks are getting sold off the most. But if you don't have protection, whether it's in the form of bonds or some cash to mitigate your losses here, you can still get 5%, as I said, in CDs or high yield savings account. You're going to feel this loss much more amplified than other people. So make sure you have that protection in your market. We have rules in our portfolio, in my family, where when markets hit a certain gauge, hit a certain level, we automatically shift and rebalance into other areas of the market. Now, I work with a professional. Mm-hmm. He does this for me based on our agreement of how much risk I'm willing to take and how much of a loss I'm willing to take. For people that don't have that and are doing it themselves, make sure your portfolio is balanced and that it's not all loaded into one sector of the market.
I think that's really interesting about your family and the finances. Do you abide by a certain ratio, X% stocks, X% bonds, X% commodities, something like that?
Yeah, we have a rules-based approach, which means when the market is trending a certain way and we look at certain technical indicators like relative strength and moving averages, but also the direction of certain sectors, we pile a little bit heavier into those sectors. But we also have always, in effect, what we call our backup or our goaltender option, which makes sure that when things start to sell off, we are not completely exposed to that, and we'll shift assets from one part of the portfolio to the other based upon market conditions. But we do that with evidence. We don't do that on a whim. We don't do that out of fear. We don't do that because the financial TV headlines are screaming markets in meltdown. We do it because we have rules that we follow, and so far so good on that.
You know, sitting in your spot at Investopedia, you have a bird's eye view of a lot of things going on in the market just by virtue of the things that people are typing into your search bar. What are you seeing people flock to your site for today and in the days past?
Did you see my correction search?
Correction was there. Bear market was definitely there. How long do bear markets last? People are wondering, first of all, we're not in one, at least not yet.
We're down 7%, so let's set the record straight.
Right, but people are hearing this, so they're looking for that. They're also looking for ways to protect themselves, but there's also some people, promiscuous investors, that have seen this before. They're looking for leveraged ways to get into certain sectors or certain stocks, whether that's a triple leverage ETF that favors tech stocks because they've been beaten down so bad, or it's other ways to approach the market right now, given the fact that there's so much selling. There's that old expression, be greedy when others are fearful, be fearful when others are greedy. I think Warren Buffett has said it, many investors have said it. Funny thing is, Mr. Buffett's been selling over the past couple of months, while the rest of us were buying and sending the S&P 500 to record highs. He was out there selling some of his biggest stocks.
Yeah, he was getting rid of Apple in a big way. We can talk about that after the jump here, but we do need to take a short break. Coming up, we're going to be talking the number 5, and we have a fashion showdown for the VIX Volatility Index. You heard that right. We take the VIX out in style. We are back, and this episode brought to you by the number 5. That's how many rate cuts investors are now pricing in by the December meeting. That number was only 1. It was about 1 at the end of April, and it was 6 at the beginning of the year. So we've kind of come round trip here. But things feel a little bit different, don't they, than they felt at the beginning of the year. Feels like we might really need these rate cuts right now. I mean, it just feels like today is a little bit more dire than it was on December 29th, 2023. Do you see the difference?
Absolutely, okay. And you're already hearing the drumbeat getting louder about a potential emergency cut, and the Fed's going to meet.
Oh, what does that look like?
I didn't even know the Fed could do that, by the way.
Absolutely, the Federal Reserve has broad powers when it comes to monetary policy and interest rates, and we remember from the COVID, when the COVID pandemic hit and everything was shut down, they didn't really wait for a Fed meeting to make those moves, and they didn't wait during the financial crisis. So the Fed has broad powers to do what it feels is necessary to make sure that we're in line here. And it wouldn't surprise me, but it wouldn't look great given the fact that Fed Chair Powell was so confident and the Federal Reserve was so confident that the economy was looking so good. And as I mentioned, headline numbers look pretty good. Inside the numbers, things don't look that great. So if the Fed does an emergency cut or cuts before September or cuts more in September than anticipated, it's not a great look because they're kind of going back on what they said. But the Fed is data dependent, and to be fair, when the Fed held interest rates last week, they hadn't seen the July jobs report, or said they hadn't seen it, and they're not political, so they don't worry about the election, and they say they don't worry too much about the stock market. But when you get a pretty good rout, sometimes the Fed does step in and just calm the waters a little.
So this is my first interest rate cycle, watching the Fed hike all the way up, and the first one where we're seeing hopefully that they make a cut soon. So I don't get it. Did the Fed just get this wrong? Did they just make the wrong call, not cut fast enough? For so long, investors have been crying for a rate cut. It felt like it was coming. It felt like it was coming. Then it was not. Then it was not. I guess I just don't get, as someone walking around on the street, why they didn't just do one little preemptive cut, maybe 25 basis points.
Yeah, well, the Fed has been pretty premeditated and very transparent about what it's doing. We've been covering markets a long time. There has been no Federal Reserve like this that pretty much tells you what they're going to do.
Yeah, I mean, remember Greenspan, he didn't even publish a notice. There was no announcement at 2 p.m. the way we're used to on Fed Day. There was nothing. You had to go to the money supply numbers the following week to back into what the Fed had done. So things have changed quite a bit. You brought up something really interesting, and I want to get back to, I don't know if you finished your answer there to Sydney.
Well, I just said, did they get it wrong?
Yeah, well, the Fed has two jobs, right? To keep inflation in that 2.5% band, right? Keep inflation sort of growing, but just a little bit, but also to keep the labor market at full employment. That's between 3.5% and 4%. The fact that we're at 4.3%, you could say, yeah, they missed what was happening in the jobs market, but to be fair to the Fed, job gains have been pretty robust.
Oh, they're still positive,
right.
too. Still above 100,000.
And there's still a lot of jobs out there, and wages are still rising. And that's one thing the Fed was trying to cool, right? We like wage inflation. That's good for workers. But too much wage inflation makes businesses ratchet up their prices, which just produces the inflationary cycle over again. So think of this as a hot air balloon, the Fed trying to keep it not too high, not too low, or Goldilocks for that matter. And did they get it wrong? In retrospect, it looks like they might have, but they were dealing with the data they had at the time.
Let's consider, I want to back up to a statement you made a minute ago, and that is the Fed could conduct an emergency meeting, could lower rates, and you said, and I believe you're correct, that the optics on that would be bad. And that's because we've seen this before. When the Fed has to make an emergency cut, it's admitting that we're in recession and things are getting bad. That's when I would expect the market to start heading into bear market if it's not already in that point. But this also ties into something that you wanted to talk about in your notes, which I like, which is that Fed rate cuts are not always good for the market.
Yeah. Fed rate cuts get investors excited because money becomes cheaper and companies borrow more, they expand, they hire, they acquire other companies. That can be a good thing. And smaller companies love low interest rates because they borrow so much money. They're so heavily in debt. When rates come down, their balance sheets look a little bit better. I get that. But when the Fed cuts into an economy that is slowing, traditionally you do not see higher returns most of the time after that. Most of the time you see pretty mixed returns, and the tendency is for the markets to go lower because, as Jared pointed out, it's an admittance that the economy has slowed potentially into a recession and it needs a jump start. It needs a jolt of energy, so lower rates will do that. Lower rates also make money cheaper for some, but it makes us spend more, which produces another inflationary cycle. So the Fed's got to be careful with that. Also, when the stock market is at record highs, as it was a month ago, why cut rates when companies are still producing profits, even though interest rates are pretty high? profits that are almost record high profits when you look at it quarter over quarter. So there was no reason to from that perspective. But if you start to hear this drumbeat get louder and louder, not just from companies like a McDonald's or a Starbucks that says consumers are holding back on purchases, and Target and the others, but when you start to see big purchases being held back by companies, industrial companies that have these long cycle orders,
good point.
Then you know we're heading into trouble right now.
We have Jackson Hole later this month for the economic symposium. Do you think you think Powell is going to say what he's going to do at the September meeting, kind of to move that along? Or
just
do you think
a month early, just tell us.
Just tell us, or could that be the emergency cut?
Up in the
at Jackson Hole, well, everybody's going to be there. I've never heard of that, but I guess it is possible. I mean, if they're all in the room and
it's basically a Fed meeting.
If something happened that was extreme, maybe, but I would say that's a long shot.
Right, it's a Fed meeting with fly fishing. So to break from fly fishing, depends how the trout are biting. I don't think that they would do that. I think there would be a lot more transparent, like they have been all along, and they would let us know that there is going to be a Fed announcement, and we would all plan for that. That's the way this Federal Reserve operates. No surprises, no drama. But we're getting plenty of drama in the markets right now, which we'll see if the Fed reacts to that, because Fed Chair Powell has said over and over again, we don't react to political influences and we don't react to markets influences, but sometimes the market influences start to bleed into the economy, and that's where the Fed has to get active.
All right, we want to circle back to the VIX right now. It has been on fire today, spiked up to 65 on Monday. That was the highest since March of 2020, the depths of the pandemic. Now, on the day it first hit that level, that's in the 60s, in March 12th, 2020, the S&P 500 would close down 26% from its recent all-time high that day. So S&P 500 down 26% when the VIX hit that level. Today, roughly the same level on the VIX. The S&P is only down 8%. So back in 2020, that day would not be the low. That 26% loss would eventually worsen to 34%. And where I'm coming from here, where I want to get to, is which market epoch is wearing this VIX surge better, today or March 2020? So looking ahead, are we going to look in the rearview mirror? Is this a one-off, or is this more the descent into something more serious?
Great question. I think that the fact that the VIX is this high right now compared to those periods, just think about what you just said, is a little bit outrageous. What precipitated all this? A kind of a sluggish July jobs report, Japanese central bank hiking rates by a quarter point. Is that really on par with what we saw during the pandemic? Is that really on par with the great financial crisis? Is that really on par with any of these big sell-offs in terms of what was happening in the market and economic dynamics around the world? I don't think so. This is an overreaction, I think, to people thinking the market was way overbought. And don't forget, a lot of people have made a lot of profit in these stocks, especially the Mag 7 and some of these other mega cap techs. So taking profit right now, this point in the year, not crazy. That's what Buffett is allegedly doing when he's selling his big stake in Apple and Bank of America. He's carrying massive capital gains, Berkshire Hathaway is, and wants to avoid a monster tax bill come next year when we don't really know the future of taxes.
Yeah, I got to say, I'm really on board. I'm more inclined to think this is a one-off. And yes, things could be getting a little bit worse over the coming days, but I don't see it as something that develops into a crisis, the magnitude we haven't seen. You know, pandemic was its own animal. We can go back to the global financial crisis. We had a lot of leverage built up in the system that had to be let out. I don't see that in the US. What I see here is Japan. Japan has a leverage problem. They're deflating today and it's bleeding over into the rest of the world. But unless that is systemic and that is ongoing over there, I don't see how it affects the rest of the world, you know, on an ongoing basis over here. So we have a few minutes left.
Yeah, we're going to get personal, Caleb. You ready?
Here we go.
So we have Investopedia turning 25.
Yes.
Yes. Tell us a little bit about the journey. Yeah.
You date back to the last century, along with Yahoo Finance, by the way.
I know.
1996.
We are cousins of Internet 1.0, and I'm so glad you guys are still here because I use you all the time. And I thank you for letting me know.
Oh, yeah. I use Investopedia all the time.
Well, we've both been around a very long time trying to educate investors about how to do this right? So we were born in 1999 in Edmonton, Alberta, in Canada. A couple of really smart guys had this great idea to put the dictionary for financial terms on the internet. They also put test prep for people who were trying to get into trading, whether it was Series 6, 73, people trying to get into the capital markets. And this was very early, right? 1999. They had this idea that if maybe they put that dictionary online, maybe this company in California called Google that was being founded in this garage in Mountain View might want to index it and point people to that. Well, they were absolutely right about that. And they grew Investopedia from this little idea into this great big site that was bought and sold several times throughout the years. We're now a part of the Dotdash Meredith family of websites. We're one of 40 odd websites there, but we are the big finance brand there. And we've just managed to continue to evolve, and we do that just by keeping it super simple, answering people's questions about money. If you do that and you do it well, you do it with integrity, with experts, you can survive on the internet for 25 years, as it turns out, and it's a terrific brand. I'm really proud to be the editor-in-chief of it, and wherever I go, people like you thank me, like I did it. I didn't do it. I'm just part of the team, so I'm really grateful that we're able to help people out, and I think we have another good 25 in us.
And you predate Wikipedia, which I was surprised to learn a few minutes ago that it was founded, or I guess launched in 2001, so by a couple of years there. I want to ask you about financial literacy. I know this is a topic near and dear to your heart. We got a couple minutes here, so tell us what you've been doing in that field.
Yeah, well, our mission is to educate people about money writ large. But in the last few years, we've been realizing that we haven't been talking to everybody. Neither has the financial services industry or financial media. We just don't talk to all the communities that need it, especially the underserved communities, and especially really young people. We know young people come to our site because they might find us through their search engine, but we wanted to put our content and our curriculum to educate young people about money front and center into high schools. So we've been on a mission the last couple of years, going into public high schools around the country, giving free curriculum to the teachers so they can teach investing and wealth building as part of their personal finance curriculum, but also training teachers how to teach it as well, and working with nonprofit groups that are really doing this on a large scale to give them our material for free so they can take it out to schools as well. We got to get people in underserved communities. We got to make sure they're getting the same access to investing and finance education as everybody else. So we are actually on the ground doing it, and we're going to continue to do that. And we've had some great partnerships over the years, and we'll continue to do that going forward.
Yeah, including Yahoo Finance here. So we wish you well on that journey. And guess what? Time flies. We got to wrap things up here, but it's been great having you, Caleb. Hopefully by the time everybody's viewing this at home, this is just a distant memory. But if it's not, re-review the sections on risk management. That will serve you well. Signing off here, Jared Blickery for Yahoo Finance.
Let's do a final check of the markets here. We're seeing the S&P 500 give up earlier gains. It was flipped briefly into the red, wavering just around the flat line. The Dow also seeing losses accelerate, down roughly 0.5%. The Nasdaq, though, firmly in the green, up 0.4% on the heels of Tesla earnings, and Tesla shares, they're up nearly 20%. That's it for Wealth. I'm Alexandra Canal. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern. You won't want to miss it.